On. All right. So what we have to know is that the company, if they want to raise finance, they will be issuing what? The security. So they can issue the shares. They can also issue the debt instruments. So it is likely the company will be incurring a transaction cost or issuing cost. How do we do with this particular issue cost? So if the company is issuing the security and the company incurred issue cost, how do we deal with the issue cost? That is what I'm coming to talk about. Okay, so the question will always give you an issue cost. They can say that the security has been issued and the company has incurred an issue cost of this amount. The issue cost that will be given to you should be treated in accordance with what we call the IFRS 9. So the transaction cost will be capitalized. Capitalizing means that you have to subtract it from the market price of the security. So if you are using dividend valuation model, you are using KE, which is DO into bracket 1 plus G divided by PO. Okay, we assume that there is no issue cost. If the company incurs issue cost and the question has given you the SD price, okay, the question has given you the SD price of maybe 15 cedis, okay, and they have given you the issue cost of maybe 2 cedis, okay, issue cost of 2 cedis, okay. The PO that you'll be using over here will be the net of the issue cost, so it will be 15 minus the 2. So you subtract the issue cost from what? From the market price. If it is for debt, you still subtract the issue cost from the market price. Okay, we assume that this particular issue cost is not tax deductible. Okay, if the issue cost is not tax deductible, you have to subtract your issue cost, the total of the issue cost from the market price, either debt or equity, you subtract. Okay, the question can also say that the issue cost is tax deductible, and the question will give you the tax rate. Okay, so they can give you the tax rate of what? 30%. Okay, the cost that we are incurring on the issue is 2 cedis, but this particular cost is going to be giving us a tax benefit of 30%. So in actual sense, you can see that if we don't incur this particular issue cost, we'll be paying what? 30% tax on all the profits. But if you are incurring the issue cost, the tax authority will allow you to subtract the issue cost from your profit before they charge tax. So it means that you'll be enjoying, or the issue cost will be reducing your tax liability by 30%. You are enjoying a tax benefit of 30% on it. In actual sense, it means that you'll be paying the issue cost of 70%. That is the cost that you'll be paying, because the benefit that you are enjoying from the tax authority, you should have. We are not solving any question. You should have paid for the full amount, but because of the issue cost, your tax liability is reducing. So it is assumed that the tax authority is paying 30% of the issue cost, and you are paying only what? The 70%. So if that is the case, you find only the after tax what? Issue cost, which will be 0.7 times the 2 cedi. Then this is the amount that you'll be subtracting from your 15. Okay, so that will be the amount that you'll be subtracting from your 15 cedi, 0.7 times 2. That will give you 1.4. So if you are calculating your cost of equity, which let's assume that the dividend is 50%, 0.5 into bracket 1 plus 0.1. These are assumed figures. Your PO will be 15 minus 1.4. Okay, that's how we go about it. So the issue cost should be treated as a normal transaction cost under IFRS 9. It should be subtracted from the cost. The assumption is that you are paying the issue cost out of what? The amount that you are raising. So you subtract the issue cost. Mostly the question will not give you the issue cost. They will give you percentages. So they will give you percentages. They can say the company incurred, issue cost of 5%. All right, seniors. So I was saying that the question will always give you the finance cost. The question will always give you the finance cost. They will not give you value, but they will give you the issue cost in percentages. You can also use the percentage to find the issue cost yourself, but that will be very complex for you. So what you do is that, okay, if the current market price is 15%, and they are saying that we are incurring an issue cost of 5%, it means that the amount that will be left will be only 95%. So what we do is that we have the DO into bracket 1 plus G over over the PO. The PO, what we do is we do 1 minus F. The F over here is the issue cost rate. So you see that if you are incurring an issue cost of 5%, then it means that you are returning only 95% of the the price, which is 15 cedis. So what we do is we do PO into bracket 1 minus 0.05, and that will give you the 95%. Okay, so mostly the question will not give you the issue cost. They will give you the percentage. So what you do is that if it is 5%, it means that you are returning only 95% of the amount that you are raising. Okay, if they say that the issue cost is tax deductible, it means that you first have to calculate tax on the issue cost and bring only the what? The after tax figure. So the cost of equity or debt, this applies to both equity and debt. Okay. So you have your DO into bracket 1 plus G. I'm using the growth formula. You can use without the growth too. There's no problem. So you have your PO multiplied by F. Okay, you have your PO multiplied by 1 minus, okay, it will be the same thing, but you are going to adjust this particular rate by the tax figure. So that will be into bracket 1 minus T. Why are we saying 1 minus T? This 5%, you will be enjoying tax benefit of 30%. It means that you are only paying 70% of this amount. So you find the 70%. That's what we are doing over here. So if you can do it one by one, there is no problem with that. But what I want to tell you is that if the question is telling you about issue cost, the issue cost is net against the issue cost is net against the amount that you are realizing from it. Okay, that is very important. I don't have any question here that I can solve on the issue cost, but I will try to look for a question on the issue cost so that I can share on the page for you people. But I just want to let you guys know about the issue cost. The issue cost is subtracted against the amount that you are receiving. If they say the issue cost is tax deductible, find the after tax issue cost and subtract it from what? The amount that you are getting, or the current market value. Okay, that is that. All right. We are coming to look at business valuation. We are coming to look at business valuation. Business valuation. Okay, mergers and acquisitions. You have to know that a business valuation, the examiner can decide to make all of them. It is going to be 20 marks, but the examiner can decide to make the calculation 14 marks and make the theory part what? 6 marks. Or they can decide to make the calculation 12 marks and the theory part also 8 marks. So you have to, the theory will always come from the side of the mergers and acquisition. You have to know the importance of mergers and acquisition. You have to know about the defensive strategies. If a company wants to acquire another company, there are some certain strategies that a company might be applying to prevent the predator company from acquiring the target company. We call something a counter offer. So if you want to buy a company, the company would rather be telling you that they want to buy you. Okay, so we have some strategies over there that you have to look at. They are very important. A situation where the managers of the company will look the company to look unattractive, or they will look the company to look unattractive. What does it mean? They will sell the what? The productive assets. If you want to buy the company, the managers will sell off the productive what assets, and the company will now look unattractive for you. You can't sell again. It's also part of the defensive strategies. The company can also, since you want to buy them, they will be looking for different people to come and buy them. That is also another defensive strategy. So you have to look at those strategies. They can bring them over there and they'll ask you to explain them or something. So you know the meaning of merger, you know the meaning of acquisition, you know their importance and how a company will want to grow. The company can grow through internal means where the company will go and set up everything. If you want to expand your operations to Kumasi, you go there, you buy a land, and you do everything yourself. Or you can go there and rent an apartment, then you bring the items there yourself. That is what we call the internal expansion or the internal development or the organic what development. But a company can go there and acquire a company that is already doing the kind of business that they want to do in Kumasi. So they will just go there and acquire a company that is already there. That is what we call the acquisition, and that is the inorganic development. That is the external development. So they can ask you to differentiate between the two, their advantages and disadvantages. So you have to be very careful with that. So we'll be looking at what we call the business valuation. We'll be looking at what we call the mergers and acquisition. Then we also look at what we call time value of money. All right. Business valuation, you have to know that we are going to be looking at valuation of equity or shareholders fund. Okay. We'll also be looking at valuation of debts. Okay. Valuation of debts, it will be both the debt will be the redeemable and then the irredeemable debts. Okay. Why should a company value a business? There are so many reasons. If the company want to go public for the first time, going public means that the company want to get listed on the stock exchange market. So the company wants to issue shares to the public for the first time. The company is a private company, and a private company, the only way that they can raise shares is through placing, where they will call some prominent people to come and buy the shares. They cannot issue the shares to the general public. So you can only issue the shares to the general public when you are listed on the stock exchange market. So the company want to get listed on the stock exchange market and they want to start trading their shares in the public domain. They have to value their business and know the value that is the company, the value that will be placed on the company on the stock exchange market. Okay. Some of the shareholders might want to sell their shareholding in the company. So you want to value the business before you know the portion that the person will be selling. The company might also be in liquidation problem that they want to close down their operations. What they have to do is that they have to value their assets and sell it and use it to settle their liabilities or their debts. The company might also value a business for purpose of taking loan. Okay, you want to take loan and they say you should use the business as a collateral security. So you have to determine the value of the company at the time that you want to take the loan so that you say, okay, this is how much our company worth. So you can give us a loan of this amount. Yes, it can also be, valuation can be done for assessing or acquisition of loans or something. Okay, so there are so many reasons over there and they can ask you, like, why should a company or why should a valuation be done on a company or why should a company be valued? They can ask you those questions. We are going to be looking at valuation of equity. Okay, let's take the valuation of equity first. The valuation of equity, the equity that we are talking about over here is just a shareholders fund. Okay, the money for the equity shareholders. So preference shares are not part. Preference shares are treated as debt instruments. So we have the first method. We can also find our shareholders fund, which is also called net asset, using what we call the balance sheet valuation model or the net asset model. How do we do that? We find the total value of the assets and we less the total value of the liabilities. So the liability, we less it. The values over here, we use the market value. Okay, we use the market value. If the question says that a company, they want to sell the company, we use the market value. But if the people just want to, the shareholders just want to value the business and know the worth and continue with the business again, then we use replacement cost. But mostly you'll be using the market values. So if you want to sell the asset today, what's the value of that particular asset in the market? So you find the market value of all the assets. But these all the assets, intangible assets, are not parts. So if you are doing this one, intangible assets are not parts, unless the intangible asset is having a market value. So mostly goodwill is not included in the assets because we can't pay for the goodwill. Goodwill is you can't pay for it, and we don't include the intangible asset unless the intangible asset is having a market value. So if you have a patent right there, nothing is being said about it, ignore it. We only value the physical asset. So if the intangible asset is not having any market value, you have to exclude it from your calculation. Okay, so we do the total asset, which is the current market value of the asset, minus what? The total liability. That's also one way of calculating it. Then we also look at what we call the price earning ratio. Okay, the price earning ratio, what we do is that we just play with the formula. We know that the price earning ratio is calculated as the market value of the company or the market price divided by the earnings per share. So what we are looking for now is the market price of the company, because the company is not listed. The company that you'll be valuing will always be an unlisted company. So we are looking for their market value. How do we find the market value? We just make the market value the subject. So the market value of the company will be equal to the price earning ratio multiplied by the earnings per share. You have to know that if the company is not listed, there is no way the company can have price earning ratio. So we use the price earning ratio of a similar company, that's the similar company in the industry in which the company operates in. So the price earning ratio will be given to you, and that will be for a similar company in which the company, a similar company in the industry in which the company operates in. Okay, and mostly if you calculate the market value using the price earning ratio, you always have to adjust it to 80%, because a company that is not listed cannot be assumed to be having the same market value of a company that is listed. So we use the price earning ratio. We also use the dividend yield model, okay, or the dividend yield issues. There are a lot of methods there, but if we proceed, we will be looking at them. So what they normally use is the net assets, the price earning ratio, the dividends model, and sometimes we also use the cash flow model. Okay, so if we try to solve a question, we'll be able to get all of them. Okay, I don't have to talk about them. If we are solving question, we get to know them. So let's take the question one. Yeah, who is reading for us?
Should I?
Question one.
Okay.
Okay.
THP company is planning to buy CRX company, a company in the same business sector, and is considering paying cash for the shares of the company. The cash will be raised by THP company through a 1-for-3 right issue at a 20% discount to its current share price. The purchase price of the 1 million issued shares of CRX company will be equal to the rights issue funds raised, less issue cost of 320,000 Ghana cedis. Earnings per share of CRX company at the time of acquisition will be 44.8 Ghana pesos per share. As a result of acquiring CRX company, THP company expects to gain annual after-tax savings of 96,000 Ghana cedis. THP company maintains a payout ratio of 50% and earnings per share are currently 64 Ghana pesos per share. Dividend growth of 5% per share is expected for the foreseeable future, and the company has a cost of equity of 12% per year. Information from THP company's statement of financial position, equity and liability. Shares, 1 Ghana cedis par value. Reserves, non-current liabilities, 8% loan notes. Current liabilities, total equities and liabilities. Required. Can you please scroll for me?
Okay.
Too much.
Too much for you. Okay.
Required. Calculate the current ex-dividend share price of THP company and the current market capitalization of THP company using the dividend growth model. B, assuming the rights issue takes place and ignoring the proposed use of the fund raised, calculate the rights issue price per share, the cash raised, the theoretical ex-right price per share, and the market capitalization of THP company. Using the price earning ratio method, calculate the share price and market capitalization of CRX company before the acquisition. Discuss the factors that THP company should consider in its circumstances in choosing between equity finance and debt finance as a source of finance from which to make a cash offer for CRX company.
Okay, thank you very much. All right. It's a very simple question. And all right. So they are saying that one company is planning to buy another company, isn't it? And they are all in the same business sector. So and it's considering paying cash for the shares of the company. The cash will be raised by TECO through a 143 right issue at 20% discount to each current share price. So if the current share price is 4 cedis, the right issue price will be 20% less than the current price. Okay. So the proportion for the right issue is 143. Okay. The purchase price of the 1 million issued of CRX Co will be equal to the right issue funds raised less issue cost of 320 Ghana cedis. Earnings per share of CRX Co at the time of acquisition will be 44.8 pesos per share. As a result of acquiring CRX, this company is expected to gain an annual tax savings of 96,000. Okay. The company maintains a payout ratio and earnings per share are currently 64 pesos. What is the meaning of dividend payout ratio? If you say the payout ratio is 50%, what is the meaning? The payout ratio is 50%. What does it mean?
It means
Okay.
that
Oh, please, you can continue.
okay, so it means that if they make a profit of say 500,000, they have to pay out 50% of that profit as dividends and
Okay.
retain the other 50%.
Okay. That is fine. So that is the dividend payout ratio. The dividend payout ratio is the portion of the retained earnings that they are paying as what? As dividend. So currently, what is the dividend? What is the current dividend that they are paying for this year? What is the dividend that they are paying for this year? Please, what is the dividend that the THQ is paying for this year? What is the dividend that they are paying for this year, Zinnes?
It's 48,000 Ghana cedis.
Are you sure? The THP Co maintains a payout ratio of 50% and earnings per share are currently 64 pesos per share. Dividend growth of 5% per year is expected for the foreseeable future, and the company has a cost of equity of 12%. What's the dividend per share that they are paying currently? The dividend per share?
32 pesos.
32 pesos. The current earnings per share is 64. So we are paying 50% of the earnings. So the dividend per share will be 50% of the current earnings per share. So the 50% will be on the earnings. We are paying 50% of our earnings as what? As dividends. And the current dividend earnings per share is 64. So 50% of that will be 32 pesos. Okay, let's now count to the requirements. Maybe the requirements will tell us what we are going to be doing. Calculate the current SDF share price of THP Co and the current market capitalization of TL Co using the what? The dividend what? Growth model. So sometimes the question will not tell you which model you use, but you can see that from this particular information that we have over here, we have to use the dividend growth model. Because if you are using the price earning ratio, you'll be suffering. So the dividend model, the dividend growth model is going to be more appropriate than any of the what? The valuation of equity. So what we do is they are asking us to calculate the PO. They are asking us to calculate the PO for this particular, for the company. So we have the business valuation and we have the question 1. Okay. Those people that will be asking for the working sheets, I'm doing this for you. Okay. So we have the question 1, which is A. Okay. So they are asking us to now calculate for the PO, but we know that our cost of equity is calculated as the DO, dividend growth model. Okay. Divided by PO or plus G. Now we are making PO the subject. All of them will now be the DO into brackets 1 plus G divided by the KE minus G. That's how we find the market price. Let's go to the question and get our dividends. What is our current dividends? We have gotten that already. That is 0.32. Okay. 1 plus our growth rate. What is our growth rate? What is the dividend growth rate?
5%.
Okay.
5%.
Okay, so you have your 0.05. What is the cost of equity? 12% minus the growth, 0.05. Okay, so your PO will now be equal to 0.32 into bracket 1.05 all divided by 0.07. Okay, let's get the total answer. So 0.32 multiplied by 1.05. I'm having 0.336 divided by 0.07. PO is equal to, what are we having?
4.8.
Okay, so the value will be 4.8 per share. So the current market price of the company is 4.8 per share. So sometimes they will ask you to use a dividend growth model. You just play with the formula. You know how to find cost of equity under the dividend growth model. So you just do your formula there. Then you make the PO the subject. The SDF price is the PO. You make the PO the subject. So it's 4 cedis.
Enough.
Yes, please.
Please, my get the deal 0.32.
You said what?
How did you get the 0.32 the deal dividend, current dividend?
Okay.
I went off. Yeah.
If you went off, that should be an opportunity cost for you, because whatever you went off to go and do, we are not part of it.
No, my this thing got finished.
Your data,
Yes.
a big man like you. Okay. It is well, don't worry. You are very fine.
Okay.
Okay. The company that we are calculating that for. Currently, they have earnings per share of 64 pesos, isn't it? Okay.
Yes, please.
Earnings is the profit after tax, the money that will be left for what? The company, the money that will be attributable to the shareholders of the company.
Yes.
But they are
Yeah.
saying that the company is having a payout ratio of 50%. So it means that any profit that they make, they are going to be paying 50% of it as dividends.
Dividend.
Okay.
Okay.
Okay. So
Okay. Yeah.
yeah, so you have gotten the 32 now.
Yeah. Yes, please.
Okay. Okay. All right. All right. So we can now move on now peacefully, isn't it?
Yes, please.
Okay. Thank you very much. Yeah.
Okay. Yeah.
So that is that one. And so they say we should also calculate what? The current market, the current what? So we should also calculate the current market capitalization of the company. Okay. If they are asking you for the current market capitalization of the company, it is calculated as the number of shares that the company is having. The capitalization rate is just that if you go to the stock exchange now, what is the value of the company then? So the value of the company on the stock exchange market, or the value of the company in the security market, that is what we call the capitalization rate. And that is calculated as the current market value of the company multiplied by the number of shares. So we have the number of shares. We have the number of shares, equity shares. It's equity shares, not preference shares. So number of shares times the what? The XD price. Okay. So the XD price now is 4.8. Let's go and look for the number of shares of the company. Can we be able to get a number of shares the company is having? So this information is relating to the company. Okay. Can we get the number of shares from the statement of financial position?
Yes, please.
3 million shares.
Yeah, so that should be 3,000.
Okay.
Yeah.
You have to,
3,000 million.
okay, that would be 3 million, isn't it? They are keeping
Yeah.
Yes,
All right.
yes, please.
So that would be 3 million multiplied by 4.8. What are we having?
So that should be 13.8 million.
Okay. So that would be 13.8 million. Okay. The question can ask you differentiate between a value of a company and market.
It's 14.4.
capitalization.
Linus, it's 14.4 million.
Okay. Okay. So 14.4 million. Okay. They can also ask you to differentiate between market capitalization rate and the value of a company. The value of a company is just the value of the company is the one that we have gotten from the statement of financial position side. Total assets minus total liabilities. That is the value of the company. So the value of the company in the books of the company itself is what we call the value of the company. But if you go to the stock exchange market, what is the value of the company shares? What is the value of the company on the stock exchange market? That is what we call the market capitalization rate or value. Okay, so you have to take note of that. That is always calculated as the SDF market price of the company times the number of shares that the company is having. All right, so we are done with the A. Let's now move on to what the B is saying. Okay. Assuming the right issue takes place and ignoring the proposed use of the funds raised, calculate the right issue price per share. So what would be the right issue price per share? You can say the right issue price is what? 20%. It's at a discount of what? 20%. Okay, to the current share price. So we know the current share price now to be 4.8. So what would be the right issue price? So the right issue price is also the same as what we call the offer price. So what would be the right issue price? If it is issued at a discount of 20% to the current share price of 4.8, what would be that value? Would it be 80% of the current price?
Yes, please.
Okay.
Yeah.
So that would be 0.8 times what? 4.8. So someone can just do the 4.8 and find a discount and subtract it. You are going to be getting the same answer, but you have to know that you are dealing with time. All right. So 0.8 times 4.8.
0.84.
Okay. So that will give us 3.84. Okay. All right. So let's go to the next one. So you see the thing answer there is the understanding of the question. So understanding of the question is also very important for whatever you are doing. Okay. Assuming the right issue takes place and ignoring the proposed use of the funds, calculate the right issue price. We have done that. What will be the cash raised? The cash raised. The cash raised. What will be the cash that we are raising? What will be the cash raised? Is the cash raised from what? Cash raised from what? That's the understanding of what they are asking you to calculate the cash raised from. It will help you to answer the question. Where are we raising the cash from? It's through the right issue, isn't it? Okay, it is the right issue that will bring the cash. Okay, and the right issue is what? 143. 143. But the number of shares that we have now is what?
3 million.
Okay, so if you are doing
Million.
if we are doing 143, what will be the number of shares that will be issuing from the right issue?
1 million.
That will be
1
1
million.
million, isn't it? Okay.
Yes, please.
All right. So that will be 1 million, and the cash raised. So our cash raised will be 1/3 times the 3 million multiplied by the what? The right issue price. Are you okay with the right issue price? We are going to be, the 1 million will be issued at what? 3.84. Okay. So that will be multiplied by 3.84. What are you having? You'll be having 3.84 million. Okay. Someone will be wondering why the issue cost is not what? The issue cost is not subtracted. Okay. The issue cost is not subtracted because the cash raise, we are going to be taking the issue cost from it before we give the remaining amount to those people. So if the question should ask you that, how much are you paying for that particular company, then that will be the 3.84, which is the cash raise minus the issue cost of 0.32. Okay. So they are not asking you the cash raise less the issue cost. What is the actual cash raised? It is the number of shares multiplied by the right issue price. But if you want to know, this is the cash raised. But if you want to know the amount that you are paying to those people, then you now take the issue cost of 0.32 from it. So that is the cash raised. The cash that we are raising from the transaction is that one. But if they ask you the cash raised net of the issue cost, then you subtract the issue cost from it. And you also not be wrong if you take the issue cost. It's based on the assumption that you are having. But you just say cash raised. Cash raised. The cash raised will be 3.84 before we pay the issue cost of what? 0.32. Or you can even pay the issue cost before you will be raising this particular cash. Okay, so that is just by the way. Okay, but you will also not be wrong if you take the issue cost from it and state that the issue cost is paid out of the cash raise, or you are doing it as like net of the issue cost. Okay, that is not a problem. And all right, so that is the cash raised, and let's move on to what they are saying again. Okay. 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 Let's come to the second one, the theoretical X right what price. How do we find theoretical X right price? Okay, we did that yesterday. We did that yesterday, and okay, so let's go to the C. So let's look at the theoretical XY price. Okay, the theoretical XY price. We have to look at the existing shares that we have.
Minus, please. It's I.
Okay. So that will be I. Okay. Should we use the unit approach or the total approach?
Let's use the total approach.
Okay. So what is the existing shares that we are having? What is the number of shares that we are currently having? 3 million, isn't it?
Yeah, 3
And
million.
Yeah.
and they are trading at what? 4.8 Ghana cedi. Okay, what will be the total?
14,400.
Okay. So 14.4. All right. Okay, let's look at the right issue. What will be the amount that we'll be raising from the right issue? Okay, the right issue will be 1 million times what? 3.84, isn't it?
84.
Okay.
Yes.
Then you subtract 0.32 from it. Okay, you can decide to leave the issue cost will be taken from the money that we are raising. Okay, the issue cost before you have the money that you'll be getting, the issue cost will be taken from the right issue. But since they are saying that you should ignore the purpose of the funds, then you can say that you are not paying. Maybe you'll be paying the issue cost if you decide to pay the money to those people. Okay, but the issue cost whenever you are making a right issue and you get the issue cost will be taken from the amount that you are realizing from the right issue. Okay. The money will be taken from the amount that you are realizing from the right issue. So that will give us what? 3.84 minus 0.32. I'm having 3.52. Okay. Like I wanted to modify the cash raise to be net of issue cost, but since it's not there like that, then let's just make it like that. All right. What will be the total number of shares that we are going to be having?
Linus,
Yes, yeah.
please, sorry to draw you back small. The 0.32, I think it's 320,000, and then the 3.84 is the
What we
the
are
right
doing,
issue per share.
what we are doing is we are not subtracting the 0.32 from the 3.84. We are subtracting it from the total figure that you'll be getting after multiplying the 1 million by the 3.84.
Okay.
So I'm
All
not
right, sure.
subtracting
Thank
it
you.
from mine. Okay. Or if you want, you can also find the 320. Okay, the 320, you are issuing the 320 on what, how many shares? The 320, you are incurring the 320 on how many shares? On 1 million shares, isn't it?
Yes,
Okay.
please.
So you can also find the issue cost per share before you subtract it from that one. So this can also be divided by 1,000. You'll still be getting 0.32, isn't it?
Okay, yeah,
Okay.
that's true.
So
Okay,
you
thank you.
can find the issue cost per share and subtract it from the right issue price before you multiply by the shares. There's no problem with that. Or you can find the right issue amount on total basis and subtract the issue cost also on total basis. There's no problem with all that. You'll be getting the same answer. So 1 million
Yes, please. Thank
multiplied
you.
by. So let's now do it to be 3.84 minus what 0.32. Let's assume that we are doing all of them to be per share. Okay. So what will be the total value here?
One for 7.52.
Are you sure? I'm getting 17.92.
It's
Yeah,
17.92.
17.92.
Okay.
Yes.
All right. So what will be the theoretical XY price? It's just the total
Oh.
market value over the total number of shares, 17.92 divided by 4 million. What are we getting?
We are getting 4.48.
4 points.
48.
Okay. 4.48. You can see that it's lower than the what? The actual market value. So whenever there's a right issue, the right issue will be done at a discount. So the discount will be affecting the share price. Okay. I'm saying that someone can also decide to, you can start at 0.32 over here, assuming that you are calculating the cash risk net of issue cost. There's no problem with that. They will still mark you because they just say cash risk and you can't do whatever, but you are paying issue cost. So you can also do net of issue cost and say the cash risk is net of issue cost. They will give you so many options there. So this is the theoretical XY price. Let's use the unit approach so that the unit approach. So this is the total approach. Let's use the unit approach. Okay. So that you also be familiar with all of them. Master the two. Don't say this one you're having problem with it, so you are not going to know. You can go to the exam, they will bring only one of them, the one that you are not okay with, and you'll be suffering there. Okay. So let's count to the existing shares. Okay. So how many of the existing shares are we bringing on unit level? It's 143. So how many of the existing shares are we bringing?
3.
Okay. And these three are trading at what? 4.8, isn't it? Okay. And that will give us what? It will still give the 14 point what?
24.
Okay. You can see that if you do it, you'll be getting the same answer because instead of us using 3 million, you can see that this is supposed to be 14.4 million, but this is supposed to be 14.4 Ghana cedis. Okay. So you'll be getting the same answer for the two all. So let's just move on with that one. You have to know that whenever there's a right issue, the right issue will be done at a discount. And that is going to be now making the share price after the right issue to be lower than the actual share price before the right issue. Okay, the price after the right issue is what we call the theoretical X right price. The share price before the right issue is what we call the cum X price. Okay, the cum X price. Okay, so they can ask you these questions and they will ask you to differentiate between them. You have to be in the position to go or to be able to what to explain. Okay.
Please come again with what you said right now.
Okay, I'm saying that the theoretical XY price is the market price of the shares after the right issue. The cum X price is the market price of the shares before the right issue. So the price of the shares before the right issue is done is what we call the cum X price. Are you okay? Okay.
Yes, please. Thank you.
All right. Some people can also call it cum div price, but the cum div will come if the dividend is part of the price, that is why we call it cum div. But if dividend is not part, we call it cum X price. Okay, so this will also be, so you have to look at the proportion in which the right issue is done. If they say 1 for 3, the right will always be the first figure. So it means that you are bringing 3 of your existing shares for 1 right. So the calculation will always be the first figure over the second figure multiplied by the existing shares that you're having. That will give you the right issue shares. So you have to take note of that. It's very important. Let's look at the next issue. Okay. They are now asking us to what? To calculate the what? The market capitalization of THCO. So after the right issue, what will be the market capitalization of the company? You can see that it's the same as the 17.92. Do we agree that the market capitalization of the company, the IV, the market capitalization of the company, the market capitalization, what they are saying now is what? What will now be the total market value of the company? It will be the existing shares. Okay, the existing shares will be now, the existing shares will now be valued at what? Okay, the existing shares is now what? The existing shares is 3 million, and these shares will now be valued at what? It will be valued at what? After the right issue, it will be valued at what?
4.48.
Okay, 4.48. Okay, and that will give us what? $13.44. Okay, and the right issue will also be 1 million multiplied by what? 4.48, and that will give us 4.48. What are you having?
Or 17.92.
17 point what?
92.
Okay. Okay, this 17.92, someone can also calculate this one like this. The person will assume that, okay, our existing shares will still be, the person will say that the existing shares will still be the 3 million multiplied by that is the issue cost per share. Okay, so the person can say that 3 million will be 4.8, that will be 14.42.4. Then the person will say that, okay, what is the amount that we are raising from the right issue? So the right issue, this is the amount that we are raising from the right issue, 3.84. And that is going to be the share value. So we don't have to do any theoretical XY price. So the person can say 1 million multiplied by the 3.84, because this is the actual cash that you'll be receiving from the right issue. And the person will now come and take the issue cost from it. So the person will assume that the theoretical XY price is not going to have any effect on the shares at all. So the person will just take the issue cost of 0.32 from this place. So it means that, and the person will still be getting the 17.92. So the person will say that, okay, the amount that we are taking from the right issue is 3.84. And that is the amount that we are taking. Nothing is going to be reducing it. But if you look at this place, you can see that the amount that we are taking from the right issue is what is higher than this one, because we have reduced the existing shares by a certain amount of money that is out. So you can just find your existing shares value, add the amount that you are realizing from the right issue, and you subtract the issue cost from it. You will still be getting the 17.92, and nobody is going to do, so nothing will be done. about it. So that is how we go about it. The market capitalization. The market capitalization is the value of the company on the stock exchange market, which is calculated as the current market price multiplied by the number of what shares that a company is having. Okay, let's look at the C. Let's look at the C. Let's look at the C. The C, what are they saying? They say using the price earning ratio method, calculate the share price and the market capitalization of CLCO before the acquisition. So let's come to the C. What are they asking us to do? They are asking us to find the value of that particular company. So let's see, we are using price earning ratio. So the market price, which is PO, is calculated as the earnings per share of the company. The earnings per share of the company that we are valuing multiplied by the price earning ratio of a similar company. Okay. Let's now look at this question. Okay, look at this question. The two companies are what? Are in the same what? Business sector. Okay. You can see that the THP co is having a market what? Value. So it means that they are listed. But since they are in the same industry with the CRS co, it means that we can now find the price earning ratio of the THP, which is a listed company, to now use their price earning ratio to value the equity shares of the unlisted company, which is the CRX co. So you find the price earning ratio of the company that is having a market value. And the company having a market value over here is the THP co. This particular company, which is a company that we are calculating, they don't have a market value. And that is why they are asking us to look for their market value. We don't have the price earning ratio also of a similar company in the same industry. But we have a similar company that is having a market value. It means that that particular company is listed, which is a THP co. So we find the price earning ratio of the THP co and use it to value the. So let's come to the price earning ratio. The price earning ratio is the market value divided by the earnings per share. What is the earnings per share of the THP co? Is 64 pesos, and their market value is 4.8 Ghana cedis. So we have 0.64 here as the earnings per share. So the price earning ratio is what?
$7.5.
Okay. So that will be 7.5 times. Okay. So the PO now will be the earnings per share of the company that we are valuing. What is the earnings per share of the CRX co? What is the earnings per share?
$44.8.
Okay. So that will be 0.448. Okay. So we have 0.448 multiplied by 7.5. What are we having? I'm having 3.36. Is that correct?
Yeah.
Okay. So what we do is that we adjust this by 80%. We reduce the value that we have by 20% or 25, because a company that is not listed cannot be having the same share price as a company that is listed. So we always adjust this by 80%. So adjust it by 80% and give me the figure. So multiply by 0.8. So I'm having
2.69.
2.69. Okay, so that will be, are they asking us to calculate per share or they just asking for value?
The share price and market capitalization.
Okay, so the share price is the 2.69, but the market capitalization will be multiplied by their number of what? Shares. From the question, what is the number of shares? What's the number of shares for the CRX school? From the question, can you see the number of shares there?
1 million.
Okay. Okay. This, why are you picking the 1 million? Why are you picking the 1 million?
When you read the question, you said that the purchase price of the 1 million issued shares of CRX Co. So that's the reason why I have taken the 1 million. So I don't know if that is
That is the reason why you have taken it. Even if
Yeah.
they are telling you that the company is buying 70% of the shares.
So if they are buying 70%, that's just the reason why.
Okay. So this one, the reason is we are looking for the total value of the company, but we don't have enough information to know the percentage of the shares that the company is buying. So we assume that they are buying the 100% of the shares. So they are buying the 100% of the shares because nothing is being said as to the percentage that they are buying. And the question also says that the purchase price of the 1 million issued shares. So it means that these are the shares that they have in issue. These are the shares that they have outstanding. So we pick the 1 million. So you multiply that by, so the market capitalization of this particular company will be their share price, which is 2.69 multiplied by 1 million. So you now have that figure to be 2.69 million. Okay. Okay. Sometimes a question can ask you to find the total value. If they are asking you to find the total value, after finding the value per share, you multiply it by the number of shares that the company is having. Okay. Let's now look at, so this one, the price earning ratio, the question will always give you the price earning ratio of a similar company that is listed, or they will give you the industry average. Use the industry average to value the shares of the company. But you have to make sure that if the question says that a company is not listed, you have to adjust the figure that you have gotten using the price earning ratio by 80%. So THP Co is the company that is listed because they have a market value. Any company that has a market value means that a company is listed. So we can find the price earning ratio of them and now use it to calculate the share price of the other company and adjust it by 80%. And that is what we have done. That is what we have done. Any other issue before we move on to the D? Okay, let's move on to the D. The D. Someone should take the D for us.
Okay, you said discuss the factors that THP Co should consider in its circumstances in choosing between equity finance and debt finance as a source of finance from which to make a cash offer for CRS Co. Stephanie.
Okay. So this is what are they asking there? What do you think they are asking there?
Okay, so I'm thinking they are asking the factors to consider in financing decision making.
Okay. 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 That is not bad. That is not bad. Works. Okay.
I also subscribe to what he said.
Okay. So who doesn't want to subscribe to what he's saying? Okay, so what are the factors? Okay, I can also see this question as the question asking me the advantages and the disadvantages of maybe the debt and equity finance, because before you can choose between debt or equity, it means that you'll be looking at the benefit that each of them will be giving to you. So you can also use the importance, the advantages and the disadvantages as also a factor to choose between the equity. Yeah, before you choose between two things, you have to look at the benefit that you'll be getting from the two of them before you make your decision. But whatever they are talking about over here, the factors or the benefits will be what will be explained in the factors. Be explained in the factors. So the first thing is you have to look at the control. You see, if you are raising finance through debt holders are not part of the owners. So they are not going to have control over the company. They don't have any ownership in the company. Okay. But if you are issuing equity, the people that will subscribe to the shares, they will become part of the owners. So the question is, do you want to have new owners? Do you want to experience dilution in the ownership? Do you want to experience dilution in the ownership? If no, then you go for the debt source of finance. So you can also say that the debt source of finance, one of the advantages is that it has no control over the company. It has no form of ownership, but the equity has a form of ownership. So you can use the control as a factor, also as an advantage, or also disadvantage to choose between the equity and the debt. The second one is the gearing of the company. What is the current gearing level of the company? Are we having more of debt already? Are we having more of debt already? If you're having more of debt, then it means that we have to go for equity. But if you are not having more of debt, we are having more of equity, then it means that we have to what? We have to get our finance through debt. Okay, that is also another factor that you have to look at. You also have to look at the risk or the security of you people having this particular, or the security of you choosing these options, or the risk. Okay. The risk has to do with if the company is out of business. If the company is out of business, which of these people will be treated as special people? If you're using debt or equity, if the company is out of business, the company is liquidating, which of these people will be treated as being a special holders of the company?
Debtors.
Okay, the debt holders, isn't it?
Yes.
Okay. So you can also look at that particular, though you don't want to, the company will not collapse. They can also look at that particular control, that particular preference that is given to them. And you can also see that if you are using debts, the debt every year you'll be paying interest. Every year you'll be paying interest. Do you have the cash to be paying that particular interest? For the equity, if no profit is made, you can decide to declare dividend or you can decide not to declare dividends. So the risks and also the security associated with what? With the instrument will also look at that particular issue. Sometimes it can also deal with the kind of investment that you want to make. The kind of investment that you want to make. So if you want to invest a large amount of money, then it will be better you issue equity. Because if you want to go for that rich amount of debt, it will put the company at risk because of the interest that you'll be paying. It will put the company, or it will put a kind of cash problems on the company. So you can also look at the type of or the kind of investment that you want to undertake. So you can also look at, you can say this as factors, or you can also use advantages of debt over equity, or what will give you or what will make you choose debt over equity or equity over debt. You can also look at it like that and answer this particular question. All right, let's look at the question 2.
Okay, question 2. Imole Company is a stock market listed company that manufactures consumer products, and it is planning to expand its existing business. The investment cost of 5 million Ghana cedi will be met by a 1-for-4 rights issue. The current share price of Imole Company is 2.50 pesos per share, and the rights issue price will be at a 20% discount to this. The finance director of Imole Co expects that the expansion of existing business will allow the average growth rate of earnings per share over the last 4 years to be maintained into the foreseeable future. The earnings per share and dividends paid by Imole over the last 4 years are as follows. Notes: Imole Co has a cost of equity of 10% and net assets per share of 65 pesos. The PE ratio and earnings yield of Imole Co has been approximately constant in recent years. Ignore issue costs. B. The net assets of Imole Co. Imole are the net book values of tangible non-current assets plus net working capital. However, a recent valuation of the business was 1.5 million above book value. Inventory includes past edition of textbooks which have a realizable value of 100,000 below their cost. Due to a dispute with one of their clients, an additional allowance for bad debt of 750,000 could prudently be made. Required: A. Calculate the theoretical ex-right price per share prior to investing in the proposed business expansion. B. Using the information provided, calculate the share price of the company prior to and following the proposed business expansion using the following valuation methods: net asset method, price earning ratio, dividend growth model, earnings yield method. Then C. Discuss whether the proposed business expansion is an acceptable use of the finance raised by the rights issue and evaluate the expected effect on the wealth of the shareholders of Imole Co. Right. Done.
All right, thank you. Is it tough? This question, the question is not even plenty. Ada, is it tough? Ada, is that
No.
it's not tough. I don't know why people are still having problem with it. All right. Okay. So the first one is what? What are they asking us to calculate for the first one? What are we calculating for the first one?
Theoretical X rights.
So what do we need?
Right.
What do we need to calculate that?
We need the shares.
Okay, we need the shares, isn't it? Okay.
And
Or
it
okay, you can see that we don't have the total value shares here. We are not giving the total value shares, isn't it?
yes.
Okay, but we are giving the right issue fraction, isn't it? You can see that they are giving the right issue proportion, 1 for 4, isn't it? Okay.
Yes.
I can also
Yes.
I can calculate. You see, I can calculate the this thing for you. Okay. I can calculate the number of shares for you. I can do that for you. But I can calculate the total number of shares for you. But what is going to happen is that I will come there. I will calculate the total number of shares for you. Okay. What are we doing the right issue for? We're doing the right issue for what? For an investment that will cost what? 5 million Ghana, 5 million Ghana cedis, isn't it? Okay. So we are doing the right issue to be able to what? Get this amount of money. Okay. So from this place, we can also do something there. But I will look at that total number because we can find a theoretical extra price using another approach. So let's just utilize that particular approach and move on. So the existing shares will be 4 multiplied by what? What is the current market price? 1 for 4. So the existing shares is 4. The current market price is what? 2.5. Okay. So the current market price is 2.5. So 4 multiplied by 2.5. What are we having?
10.
Okay, that will be 10. So the right issue price will give us what? Would that be 0.8 multiplied by 2.5 at?
Yeah.
Okay. So let me just do 1 first and calculate that one. So it will be 1 at 0.8 multiplied by 2.5. Are we okay with that? Because the right issue will be 20%. It will be at a discount of 20%. So it means that you'll be getting only 80% of the current market price. What are we getting?
2. You get 2.
You get 2. Okay. So it means that you are going to be having 12, isn't it?
Yes.
Okay. And the shares will be 5. So our theoretical XY price will give us 12 over 5. What are we having? 2.4. Okay. So that is the theoretical XY price. Okay. Let's now come here. What is the total amount that we are raising from the right issue? What is the total amount are we expecting to raise from the right issue? All right. Let me
5
5 million.
million.
5
Okay.
million.
We are expecting
5
to raise 5 million, isn't it? Okay. But this 5 million, we are going to be issuing a certain number of shares at 2 cedi, isn't it? You see that the right issue will be done at 2 cedis per share. And we are expecting these 2 cedis per share to give us a total of 5 million. So the question now is, how many shares are we issuing to get the 5 million? So the number of shares will now be calculated as, so the number of shares from the right issue will be calculated as 5 million over the share price of 2. Okay. 5 million over the share price of 2. And that will give us 2.5 million shares. How do we get that? It's just like the number of shares, which is X times 2, will give us the 5 million. So the number of shares that the right issue shares that you are having, if you multiply by the right issue price per share, you'll be getting a total value of 5 million. So how many shares are you getting from the right issue? It's 2.5 million shares. Okay. But you can see that the right issue is 144.
Linus,
Yes, please.
please, how did you get the 0.8?
Oh. 0.8.
Yes.
Okay.
0.8.
Okay. The current share price of Imoleco is 2.5 Ghana cedis per share. And the issue price will be at a discount of 20% to this.
20%. Yes.
Okay. So you see that the current price now is 2.5, but the right issue price will be 20% less than this. It means that you are only going to be getting 80% of this one, the 2.5. Or you can find, you can, if you like, you can find a discount on this particular amount and take it from the total amount. So 0.2 times 2.5, that is the discount value. But they say that the right issue will be 20% discount of, take the discount from it, be getting the 2 million. Anyhow you want to do about it. Okay.
Thank you.
You're welcome. All right. So the fraction for the right issue is what? It's 144, isn't it? Okay. So the right issue is calculated as 1/4 times the existing shares, and that will give us the 2.5. What will be the number of existing shares that the company is having? What will be the number of shares that the company is having? The existing shares. The right issue is giving us 2.5 million, and the proportion is 144. So right issue is equal to 1/4 times the existing shares is equal to 2.5. So the company is currently having existing shares of 10 million. Okay, that will be 2.5 times 4. That will give us 10 million. So the company is now having 10 million shares. That is what they are doing, 144, and they are having 2.5 as a right issue. So that is the existing number of shares. Okay, you need to find this particular existing number of shares before you can use the net asset method. Okay, so we have done with the theoretical XY price already, but they are saying that using the information provided, calculate the share price of the company prior to and following the proposed business expansion using the following valuation methods. Using the following valuation methods. Okay. Let's say we should use net assets method, price earning ratio, and the dividend growth model and earnings yield. Okay. Let's come here. Are we giving assets and liabilities in this question? Are we giving assets and liabilities? Are we giving assets and liabilities?
Yes.
Can you see any assets and liabilities there?
Yes.
What are they? I can't see them.
Note B.
Okay, they are just giving you some values of the assets, not the assets and liabilities. Okay. We are not giving assets and liabilities, but we are giving some information on assets. Okay. We are giving some information on the assets. Let's come here. They say that they say that Imoleco has a cost of equity of 10% and net asset per share of 0.65. The price earning ratio and the earnings yield of Imole, who has been approximately constant in recent years. Ignore issue cost. So they are giving you net asset per share. Net asset per share. How do we calculate net asset per share? How do we calculate net asset per share?
Net asset over number of shares.
The net asset, is it total or just net assets?
Total.
Okay. So it will be total net assets over the number of shares, isn't it? Okay.
Yeah.
So the net asset per share is calculated as the net asset per share is calculated as total assets. Okay. It's calculated as the total net assets rather. So total net assets divided by the number of shares. Okay, and we know the value is 0.65 and we don't know our total net assets. Okay, we don't know our total net assets, but we know our number of shares to be 10 million. Okay, so we can say that our total net assets will now be 0.65 multiplied by 10 million. Okay, so the net assets is it will be 6.5 million. Okay, that will be 6.5 million. Okay, so that is the net asset that we have calculated. That is the total net asset. But this particular net asset we are calculated without taking into consideration the footnote that we are given. So we now ask ourselves, this particular net asset is the total asset minus total liabilities. But the total asset was determined without taking the footnote B into consideration. So we have to come and adjust our net assets now. So the B, we have this, then we have the net assets method. So you have your net assets before the adjustments. And that will be 6.5 million. Then you now come to your statement, the footnote B now. Okay, the net assets of Imole are the net book values of intangible non-current assets plus net working capital. However, a recent valuation of the building was 1.5 million above book value. What is the meaning of that? What is the meaning of that, seniors?
It is more than the book value.
Okay.
Yeah, so it means they've done a new valuation.
The balance sheet.
There is a gain on the assets.
Okay, so what do we do?
We less
we add it back.
Okay, so we add it to what? It means that that 1.5 has not been taken into consideration. So the asset was valued at a value lower than this particular amount. So we go and add it. So we have building of 1.5 million. Okay, so the amount that we put over there is 1.5 less than the actual amount. So we go and increase it by, this is a revaluation gain. So it will not affect the profit. It's a revaluation gain. It will go to other comprehensive income. Let's come to the next one. Okay. Inventory includes past edition of textbooks, which have a realizable value of 100,000 below their cost. What is the meaning? Inventory includes past addition of
So it means we'll
It means what?
So it means that the current value of the inventory is more than its net realizable value.
Okay. So what do we do?
So in that case, we subtract the 100 cedis from the inventory.
Okay. So the inventory has a net realizable value of 100 Ghana cedi below their what? Their cost. So it means that the cost that we have included over there is higher than the net realizable value by 100,000. So it means that the value included in the net asset is higher than the actual value by 100,000. Let's go and remove that. Okay. So they can also say the net realizable value have 100,000 above their cost. It means that they are more than their cost. But in this case, they are less than the cost by 100,000. So we go there and have what? Inventory. Okay. Inventory, then we subtract 0.1. I hope we are okay. Okay. Would this particular adjustment has effect on the profit for the year? Would this particular adjustment has effect on the profit for the year?
Yes.
Okay.
Yes.
All right. So we can also go and adjust our profits now. So let's go and adjust our profits. Okay. Someone will be asking, where is the profit coming from? Okay. It's very simple. Profit after tax. Okay. I will show you right now. How do we calculate earnings per share?
Put earnings attributable to the shareholders.
Okay. Divided by
the number of shares.
ordinary
Okay.
shares.
What is the earnings per share for 2x7? The 2x7 is the current year. What is the earnings per share for them?
32.4.
32.4.
32.4.
Okay. So how do we get that 32.4? It is the profit after tax divided by the 10 million shares. So we can say our profit after tax is 0.324 multiplied by 10 million. What are we having? So I'm having 3.24. Okay. So the inventory adjustments, this is this is an impairment of inventory that will be subtracted from this one, 0.1. Okay. Let's go to the next one. The next one is what?
Bad debt.
Bad debt
Okay. So what do we do to the net assets?
due to a dispute with it means that we take out
Okay. So the net assets will be taking 0.75. Okay. Would this affect the profit for the year? Is the bad debt profit or loss item?
Yes.
Okay, so we come and subtract 0.75 here. Okay. Is there any other adjustment that we have to do? Is there any other adjustment that we have to do to the profit? Okay, let's now find our net assets now. The business valuation, the items that you'll be adjusting more will be the net assets and also the profits. They'll be giving you some items that were not taken into consideration before the net assets. So you have to now bring those items into the picture. Okay, it's just like the consolidation that you have been doing at the date of the purchase, you have to value the assets and liabilities of the company. So it's the same thing. You bring the asset to their fair value. That is all. All right. So let's find the actual value for this.
7.15.
7.15. Okay. So they are just asking us to find, are they asking us to find the value per share? Okay, they say share price of the company. So the share price, it will be the value per share. So this is before. So our net asset per share will be calculated as 7.15 divided by 10 million. What are we getting? 0.715 per share. Okay, they say prior and following the what? The right issue. So that is the first one. Okay, so that is the first one. But if the right issue is done now, you see that there will be one, we are going to be having 7.5, that is the before the right issue. Then you now add the right issue amount to it. So you now be having 12.7, 12.15. Then you now divide all of them by 12.5 because you're having existing shares of 10 million. The right issue will be bringing a share of what? 2.5 million. So your net assets will now be increasing by the amount that the right issue is bringing, which is 5 million. And the shares will also be increasing by the shares that you are issuing to the right issue. So that will be 12.15 divided by 12.5. That will be the value of a share after or following the right issue. Following the right issue. Let's adjust the profit.
Profit 2.39.
Okay, 2.39. Okay, 2.39. Let's find the earnings per share now. That will be 2.39 divided by 10 million. What are we getting?
0.24.
Okay, 0.24. So this will be approximately 0.24. Okay, so let's now look at the other methods that they are asking us to use. Okay, we should use a price earning ratio. We should use the price earning ratio. Okay. The question says that the price earning ratio and then the earnings yield of the molecule has been approximately constant in recent years. Has been approximately constant in the recent years. So what we do now is that we have to find our price earning ratio. So we are not giving the price earning ratio. Since this particular company is listed, it means that they will be having a price earning ratio on their self. So let's find the price earning ratio for ourselves. That will be the market price over the earnings per share. Okay, then that is it. So the market price, the current market price is 2.50. Okay, divided by the earnings per share. The earnings per share that you'll be using will be the one that you have over here, not the adjusted one. So use the 0.32. Okay, 0.324. Use that one. So 0.324. Don't use the adjusted one. Okay. So what will be the 2.5? The 2.5 is in cedis, but the earnings itself is in what? Is in pesos. So you change to cedis. You can only you can compare cedis with cedis. You can't compare pesos and cedis. They are two different things. Okay, divided by 0.234. I'm having 7.7. Is that correct?
$7.7, yeah.
Okay. So our market price under the price earning ratio is price earning ratio multiplied by the earnings per share. The earnings per share that we are going to be using will be the adjusted one. So we have 7.7 multiplied by 0.239. What are you having?
$1.85.
Okay.
1.8.
Okay. This 1.8 is before. They say you should do proud and following. So this is before. Let's go to
Linus.
Hello,
yes,
sir.
ma'am.
Please, it's 1.8. It's not 1.85.
1.8. I'm coming. 7.7 times 0.239. I'm having 1.84.
Yes.
Okay. Yeah, someone mentioned
Yeah,
that. Yeah.
yeah, please.
No,
How did you get the 0324?
It's 32 pesos that we are changing to cities.
Oh, okay.
Is this figure? We calculate this, we do all the workings for the current year, and the current year is the 2x7. So we use the earnings per share for them over here. So their earnings per share over here is 32 pesos. So we change it to cities because the share price is also in cities. So we do the workings, all the workings in cities, or you change all of them to pesos and do your workings in pesos.
Thank you.
All right. So let's now look at that is before. Okay, they say following and what? This particular issue. Let's look at it. Okay. The finance director of the e-molecule expect that the expansion of existing business will allow the average growth rate of earnings per share over the last 4 years to be maintained in the foreseeable what? Future. So right now, if we are now doing the investment, it means that the earnings per share will now be what? Increasing in the same proportion. So the following one, we have to increase our earnings per share by the increment. That is the only thing. How do we find the increment over here? How do we find the growth in the earnings per share? The growth is the same as how we calculate growth for dividends, how we calculate dividend growth. Okay, so the growth will be calculated as the end fruit of D1. Okay, let me just say the E1 over E0, which is the current earnings divided by the old one, all of these minus 1. All of these minus 1. Okay, so that's how we do. Or if you can't write this particular thing, just write this. Write the E1 over E0 or exponent 1 over n minus 1. Then you multiply your answer by 100. Okay, another way of calculating that is that one. Let's go to the question. What is our current earnings per share? The current earnings per share will be the current year, the most recent year, which is 32.4. So 32.4. And the initial earnings per share is 27.7. So 32.4 32.4 32.4 divided by 27.7, all exponents. What is the number of growth the earnings has experienced?
4.
Okay, it's 4. Okay, so that is very important. That is 4. So 1 over 4 minus 1. Then you multiply all the answer by 100. What are you getting?
Getting 4%.
Okay, 4%. So what you do now is that the after what you do is for the after, your market value per share will be the 7.7. Then you multiply your earnings by the 4. You now adjust your earnings over here by the 4% growth. You assume that it will grow in the next year. So you adjust it by the growth of 0.239. So put all of them together and get the answer. Okay, so that will be 1.91. Someone will be asking why we did not adjust the the market value after using the price earning ratio. The company itself is listed, so we are using their price earning ratio to calculate the market value for them. So there is no adjustment. We only do the adjustment if you are doing it for unlisted company. This company itself is listed, so we don't do anything for them. Let's look at the next method that they are asking us to use. Okay, the next method that they're asking us to use is what?
Dividend growth model.
Okay. The dividend growth model, what we are going to be doing is that we have the PO is equal to DO 1 plus G over the KE minus G. If you do this one, this is just a proud, this is following. So this is following. That is the dividends we use next year's dividend. That is following the growth. But if they say proud, then you use the current year dividend only. But let's just use the proud because this is what you'll be seeing. Let's use the before or the following. This is what you'll be seeing in the exam. So we first of all have to calculate the growth because the growth has not been given to us. So let's go and take our dividends one by one. Let's take our dividends one by one. What is the current dividend? 15.0, and the initial dividend is 12.8. The growth will also be 4. So we have 15.0 divided by 12.8 exponent 1 over 4 minus 1, all multiplied by 100. What are we getting?
$4.
Okay, that one too is 4%. Okay, so we'll be having 0.04 divided by the KE is what? What is the cost of what? The cost of equity.
$10.
Okay, the cost of equity of the company is 10%. So 0.1 minus 0.04. What are we getting?
I got 260.
Okay, it's supposed to be 2.60 because this is supposed to be 0.15.
It's a close. Okay.
Okay, so 2.60. Okay. Let's come to the next one, which is the earnings yield. Okay, the earnings yield, what we do is that we use earnings per share into bracket 1 plus G. Then we use earnings yield minus the growth. So it's just like the dividend growth, but instead of dividend per share, we use the what? The earnings per share. Instead of cost of capital, we use the earnings yield. So we have to calculate the earnings yield, which the question has said already. Okay. So we have the earnings yield. The question says that it has been constant every year, and the earnings yield is calculated as earnings per share over the market price per share. So the earnings per share for this year is 0.324, and the current market value is 2.50. So what are we getting for the earnings yield? You multiply the answer by 100. So 0.324 divided by 2.5 times 100.
4.96.
Okay.
Please, can you go back? I want you. Hello, Linus.
Yes, please.
Yes. The 12.8. Please, how did you get it? Oh, okay.
If you are writing as I'm talking, there is no way you are going to take anything to the house. So just just pay attention. If I'm done, I will share the screen with the working sheet with you. So then your attention is very important. Okay. Though this question is somehow complicated, but it will bring all the necessary issues that we have to understand. So that is so what we do now is we use our earnings for this year, which is the adjusted one. So our market price per share will be calculated, our earnings that we have calculated this year, which is 0.239, 0.239. Then we factor in 1 plus the growth, okay, divided by 0.1296 minus the growth. So the answer that you are going to be getting will be the answer that you are going to be getting will be that particular, will be the market price under the earnings yield. Please, what are we getting? What are we getting?
2.77. 2.77.
So 2.77. So that is the value for that particular one too. Okay.
Sir,
Yes, please.
Salami,
Yes, please.
please,
Please, why is the growth 0.04? Is it because it's 4 years interval? Oh,
We have a way of calculating the growth, and I've written that particular growth. How we calculate the growth. This is how we calculate the growth. If it is for dividends, if it is for earnings, that is how we calculate it. If it is for dividends, what is the dividend? So they all follow this particular one. The growth is calculated as if it is dividend, it can be earnings. It will be the current earnings, which is D1 over the initial. So the earnings for this year or the dividend for this year divided by the first dividend that you have paid, all exponents 1 over n. Then you subtract 1 from the answer. Okay, so it's not that we are saying that it is 4 years, that is how we do it. No, we have a way of calculating it. All right,
thank you, sir.
okay. So let's go to the next one. And okay, let's take that and take another question. Then we take some 30 minutes. I say 30 minutes and 10 minutes break and come back. Yeah, please read the C for us.
I said, discuss whether the proposed business expansion is an acceptable use of the finance raised by the rights issue, and evaluate the expected effects on the wealth of the shareholders of Imole Co.
Okay. All right. What before the right issue, what was the value of the company? It was 10 million at what? 2.5. They have existing shares of 10 million and each share is trading at what? 2.5. So that will be 12.5. Okay. After the right issue, the value of the company will now be what? After the right issue, the value of the company will now be 12.5 plus this one. That will give us 17.5. Okay. Let's now come to this side. What is the theoretical XY price that we have calculated?
Yeah, Linus, I beg you, go back, make us see something. Is it 10 times 2.5 or 10 plus 2.5?
Which one?
The one you just wrote, the 10, not this one. I think the question sheet.
Okay, this side. This one is gone. Okay.
Ah,
So I've written 10 multiplied by 2.5. That is the existing value of the company.
okay. That would be 25.
Okay, that will be 25.
Yes.
Okay, okay. Then
Yes,
now
please.
they will now be having a share of what? 5. The right issue will be 5, isn't it?
Yeah.
Okay. So that will give us a total value of 10 million. Okay.
30.
Okay. So, but they say you should discuss the proposed business expansion as an acceptable use of the finance raised by the what? The right issue. You can see that they are saying that if the expansion is done, the earnings of the company will continue to grow in that manner. So for that particular side, it's going to give a positive return. The investment is going to give a positive return because they said that if the business proposed investment is carried out, the earnings of the company is going to grow in that particular proportion. So the next year, the earnings of the company will grow by 4%. So we can see that this is actually a good return on investment. Why are we saying it's going to be a good return on investment? You see that the company will now be having 12.5 shares, 12.5 shares, and they will be paying 12.5 shares. Let's look at the earnings per share there. What will be the earnings per share there? what is the current earnings per share now is 32.4. Okay. So if the company is going to grow in that particular manner, it means that this particular earnings is going to be increasing by 1.04. Or you can also use the price that you have calculated using the earnings per share. And this will be, how do we calculate that? How do we calculate the earnings per share? Okay, you can calculate the price earning ratio by using your earnings per share multiplied by the, okay, so let's calculate the market value. So the market value multiplied by is equal to earnings per share multiplied by your price earning ratio. Okay, the market value. So the earnings per share that you will be calculating, you assume that you haven't adjusted that. So 0.324 multiplied by 1.4. You put in the growth. Then you multiply by 7.7. What are we getting as the answer? I'm getting 2.59.
Yeah.
Okay. So you can see that the market value that the earnings per share will be given to you following the proposal is 2.59. But what is the theoretical XY price that we have? The theoretical XY price of this particular share is what? We calculate the theoretical XY price somewhere. Okay, it's 2.4.
2.5.
Okay, it's 2.4, isn't it? The theoretical
Yeah,
XY price is 2.4.
Yes,
Okay.
please.
So the actual market value of the shares after the right issue now is 2.4. But if you do the proposed investment, the value that the price earning ratio will be given to you is 2.59. You can see that there is an increment in the price, isn't it? There is an increment in the price. There is an increment of 0.159 something or 0.0519. So this is also a good investment because the share price projected by the price earning ratio is different from the what, or is higher than the market value that we are having now after the rights issue. So that is also a nice investment. So you can use the price that you have calculated using the price earning ratio, compare with the actual price and see whether there is an increase in the price over there. If there is an increase in the price over there. Okay. Another one is if it is going to increase the shareholders' wealth. Yes, the share price suggested by this is 2.59, whilst the actual price is 2.4. Or the shareholders are going to be buying the right at 2 cedi and they will be selling at 2.4. It means that they will be having a value of a right of 0.4. That is also something that if they sell the shares, they are going to have a capital gain of 0.4 per the share that they will be selling. So that is also a good investment, and that is going to increase their worth through the capital gain of the 0.4 per a share. Okay, let's take like oh it's okay. Let's take the 4. Let's take the question 4. Hey, mergers and acquisition is also here. Let's take the 4 and 5. Then we go for some break and come back at 9. Who's taking the 4 for us?
Okay, question 4. Phobis company has an issue 9% bonds, which are redeemable at their par value of 100 cedis in 5 years' time. Alternatively, Each bond may be converted on the date into 20 ordinary shares of the company. The current ordinary share price of Phobisco is 4 CD 45 pesos, and this is expected to grow at a rate of 6.5% per year for the foreseeable future. Phobisco has a cost of debt of 7% per year. Required, calculate the following current values for each 100 Ghana cedi convertible bond. A, market value. B, floor value. C, conversion premium.
Okay. So this particular question is about calculating the value of a convertible instrument. So they are asking you to calculate the value of a convertible instrument. Okay. First of all, what you have to know, what you have to do is that they are saying that the instrument can be converted at par, or it can be converted into equity shares. So what you do first is that you first have to see whether the instrument will be convertible. It will be convertible if the value that you are receiving for the shares is higher than the amount that you'll be receiving in cash. That is why you go with it. So you first of all test and see whether the instrument is convertible if the shares that they are receiving, the value of the shares that they are receiving is higher than the nominal value. If that is the case, then we have to calculate the market value using the conversion side of it. Okay. Okay. So let's see if you are converting. Okay. How many equity shares are we receiving? Alternatively, each bond may be converted on that date into what? 20 ordinary shares of the company. The current ordinary share price of this one is what? 4.45. And this is expected to grow at a rate of 6.5% per year for the foreseeable future. When are we converting the instrument? When are we converting the instrument? It's in 5 years' time, isn't it? We are converting in 5 years' time. Is that the case?
Yes, please.
Okay. If you are converting in 5 years' time, would the share price still be 4.45 in the 5 years' time?
No.
No, please.
It will be growing at 6.5% every year. So we have to estimate the share price in the 5 years' time. So what will be the share price? You use the principle of what? Compounding. Okay, so it will still be the present value into bracket 1 plus r exponent n, because this is compound. It will be increasing every year by 6.5. So at the end of the 5 years, what will happen? We have the 4.45 into bracket 1 plus the growing rate, which is 0.065 exponent 5 rather. This will be done in 5 years time. Okay, so you can do this and give me the answer straightforward. So 1.065 exponent 5. What are you having?
$6.1.
6 points.
1.
Okay, so 6.1. So the share price in 5 years time will be 6.1. And how many shares are we going to be receiving? So equity value. So in 6 years time, in 5 years time, if we want to receive the 20 shares, the 20 shares will be valued at the market price of 6.1. So what will be the total value of the shares that you'll be receiving there? I'm having 122. Is that correct?
Yes, sir.
Okay. Is it higher than the
Yes,
par
sir.
value? Is it higher than the par value?
Yes.
They say you can either redeem at par or you convert it to equity.
Yes, please.
You
Yes,
can
please.
you can only convert if you are going to be receiving a value higher than the par value. They say the loan can be redeemed at par value, or you receive what? Equity shares. You ask yourself, what is the value of the equity shares you'll be receiving in the 5 years time? It's 122. The par value that you're receiving in the 5 years time is also 100. So it means that the equity is higher than the what? The par value. So you now decide to convert. So we find the market value now. Okay. The market value is just the present value of all the cash flow that we'll be receiving, which will be discounted at the cost of the what? The debt. Okay, so we have the years, we have the cash flow, we have the discount factor, then we have the present value. Okay, so this one is not like we are coming to find internal rate of return. The question will always give you the cost of what? The debt, which is the internal rate of return. What is the cost of debt over here? What is the cost of the debt?
7%.
Okay, so the 7% will now be our discount factor. Okay, so we now have,
7.5.
okay, then we now have year 1 to year 5. We'll be receiving interest. Year 1 to year 5. What will be the interest that the people will be receiving? Year 1 to year 5. What will be the interest that you're receiving every year?
90.
Okay, you can see you are not giving tax, so you ignore the tax. So that will be 90. Okay, annuity. So year 5, you receive equity shares. Okay, so you receive the 122. So what is the annuity? 7% for annuity 7%. What are you getting?
4.100.
4.100. Okay. Discount factor 7% in the 5th year. What are you getting?
0.713.
0.713. So let's find their figures now. What are we having?
36.9 for the first one.
Okay.
And 86.99.
86.99. Put the two together.
123.89.
123.89. Okay. This is the market value. Okay. So the market value, you see, what we have been doing is that, you see that if the first one, we put a market value here first before we discount the cash flow, isn't it? Okay. So this is the market value that we'll be putting there to discount the cash flow. And so we are looking for the market value that we put there first and subtract. The first one, we just use a guess rate. We use a guess rate. But now they are giving you the cost of capital. The cost of capital itself. So the cost of capital is the rate that will make the cash flows be the same as what? The present value of the shares, or the present value of the cash flows be the same as the current market value. That is the cost of capital. What rate is going to give us a zero return on the what? On the instrument? What rate is going to make the present value of all the cash flows be the same as the current market value? So this is the rate. The rate that we are going to be using is the 7%. So it means that if you use the 7% to discount all the cash flows, the answer that you'll be getting will be the same as what? The current market value. So that is how we get a current market value. Use the cost of capital to discount all the necessary cash flows that you'll be discounting. The answer that you'll be getting is the current market value. All right. So that is the market value. Let's count to the floor value. Okay. The floor value is just if you are doing the discounting or if you decided to redeem at par, what would be the current market value that you'll be receiving? That's what we call the floor value. So if the redemption should be done at par, what should have been the present value of all the cash flows? So we use the same thing over here, which will be years. We have the cash flow. We have the discount factor, which will be 7%. But the last year cash flow will be 100, will not be 122 because we are not converting. That's what we call the floor value. So the floor value is what will be the value if you are redeeming at par. So we have 1 to 5. The cash flow will still be 9. The discount factor will be 1.00. So this will be 36.9. Then 5, we now have 100. We are not converting, so we are not going to be having equity value. We now be having par value, which will be 0.713. So that will give you 71.3. What are you having? That is what we call the floor value. So the floor value is if you are redeeming at par, what will be the present value of all the cash flows? That is the floor value. What are you getting?
Hmm. 108.2.
108 point what? 2. Okay. They are asking for conversion premium, isn't it?
Yeah.
Okay.
Thank
They're
you.
asking
Compare
for
the price.
okay. They're asking for conversion premium, and you think what should be the answer?
You compare the two rates that we calculated, the market value and then the floor value.
Okay.
The
So
difference is the conversion premium.
what are you getting?
I'm getting 15.69.
15 point what?
69.
Okay. You say you are getting 16.
15.69. 15. 1.5.
Okay. Okay. That is one way. So the conversion premium. Okay. So you can do the 123.89 and 108.2. Okay. Another way of doing it is that the conversion premium, you can look at the current market value of the debt and also if you want to convert now, what's the current value? It will be 4.45 times the 20. Then you subtract it from 108.2. Okay, you can do the two like this. There will not be any problem. So this one is the current market value that if you are doing the conversion, the current market value is 123.89. That means the conversion will be done in 3 years' time. These are the options. But if you want to convert now, what will be the value? It will be 4.45 times 20. You can also find the conversion to this side. You assume that you are doing the conversion now, or you are doing it in 3 years' time. There's no problem. They will mark that to you. All right. All right. So let's take the last one, then we take some break.
All right. Question 5. company XX intends to buy company YY. XX has a market value of 200 million, while YY has a market value of 100 million. XX believes that if it buys YY, the resultant firm will be able to save marketing and overhead costs by 20 million every year forever. XX pays 105 cash for YY and opportunity cost of 20%. Opportunity cost of capital is 20%. Required, calculate the cost of required. What is the cost of this transaction? B, what is the gain from this transaction? C, what is the net present value of this transaction to shareholders of XX? Then D, what is the gain to shareholders of YY? Then, supposing XS buys YY by issuing 100,000 of its own shares to shareholders of YY instead. If XS had 20,000 shares issued prior to this transaction, compute the cost of this transaction if the post-announcement share price of XX rises from 10,000 to 10,800. What is the net present value of XX?
Okay. So this particular question is about mergers and what?
Merger. Simple.
Okay. You are seeing that they say company X intends to buy company YY. SS has a market value of 200 million, while YY has a market value of 100 million. Okay. SS believes that if what is this? SS believes that
so if it buys,
okay, if it buys YY, the resultant firm will be able to save marketing and overhead costs by 20 million every year forever. Okay, so what is the savings over here? The gain will always be the savings, but what you do is that you present value the gain. So this is a perpetuity. You have to discount it. You have to present value it. SS pays what? 105 million cash for YY, and opportunity cost of capital is 20%. What is the cost of this transaction? The cost of the transaction will always be for the buyer. Who is buying? Okay. What is the value of the company that they are buying? What is the value of the company that they are buying?
100 million.
Okay. How much are they paying?
105 million.
So how much are they paying in SX?
5 million.
That is the cost. That is what we call the cost. Okay. So the cost will always be the excess amount that the buyer is paying for what? The shares or the value of the seller. So the cost is always calculated as the cost of the transaction is always so the cost is calculated as the cash payment minus what? The value of the company that they are buying, which is the YY. Okay, the value of YY. So we are paying 105 for 100. So the cost is 5 million. Okay, that's how we calculate the cost. So the cost is the cash paid, or it can be a share exchange. So what is the value of just the consideration? Just take it like the consideration. What is the consideration that we are giving for the shares? That is the cash, or it can be shares. If you are exchanging shares, what is the value of the shares that you are exchanging? For how much? So in financial reporting, this will be called goodwill. This will be called goodwill. But if you come to financial management, it's called a cost. It's an additional cost to what? To the buyer. Okay. Let's now come here. The next thing that they are asking us is that what is the gain from this transaction? The gain will always be the cost savings or the additional benefit that the company will be getting as a result of the merger or as a result of the acquisition. What benefits will the acquisition be bringing to the company? It will be bringing them a cost savings of what? 20 million. So that is a gain. But this particular gain, we always have to find it to the present value because it's today. We want to know what is the today's value of the gain. So you always have to present value the gain. So we have the gain to be equal to the cash flow over the R because it's perpetuity. Perpetuity is the cash flow, or it's 1 over the cash flow multiplied by 1 over the R multiplied by the cash flow. So our gain is equal to 20 divided by the opportunity cost of capital. That is the cost of capital of the company. So the opportunity cost of capital is 20%. So that will be 0.2. 0.2. What are we having as the gain?
100.
100. Okay. Sometimes the question can ask you to find the total value or the combined value of the two companies. The combined value is that, okay, after the acquisition, what is now the value of the company? Okay, you see that the value of the the value of XX is 200, isn't it?
Yeah.
The value of YY is what? 100. Okay. But anybody that is coming to buy this particular company will be receiving a gain of 100, isn't it? The person will be having a gain of 100. If you are coming to buy the company now, it means that the administrative costs and those things will be saved for you and you'll be saving administrative costs of 100. So in actual sense, if you want to sell the business to you right now, we sell the business, we add our actual price plus the 200, then we take into consideration the gain. We take into consideration the gain that we're making. Okay. If my car, or if I have a car, and the car is 100 million, but the car that you are currently having is also 100 million. Okay. Or the car that you are currently having is 115 million. But what will happen is that if you are buying my car, you'll be able to be saving a fuel cost of 20 million. Okay. You'll be able to be saving a fuel cost of what? 20 million. The maximum amount that you can pay for my car will be the 100 plus what? The 20 million. Because if you buy the car, you will not be buying fuel for 20 million. So you can see that you are adding the 20 million to what? To the value of the car. That is the maximum amount. So the combined or the total value of the company will be the value of the two companies plus the gain. Because anyone who is coming to buy the company now will be having the gain. So the combined value is always the total value of the company plus the total value of the two companies plus the gain. Okay, so we have the 100 plus 200 plus the 100. That is how we find the combined value. So the combined value will be the value of the two companies plus any gain that will be coming from the transaction. Okay, let's come here. Let's come here. What's the gain from this particular transaction? We have done that. What is the net present value of this transaction to the shareholders of what? Of XX. Okay. So the net present value is calculated as the actual gain that is coming from this particular transaction. You see that the gain that the company will be getting is 100, isn't it? The gain that the company is getting is 100. But they are paying 105 for 100. It means that they are incurring a cost of what? 5 million. So in actual sense, the gain that they will be receiving will be 100 minus 5. Because before you can get this particular gain, you have to pay an additional 5 million for the value of the company. So if you want to know the actual gain, which is what we call the present value, you take the cost from the gain. That is the net present value. That is the actual gain that the company is getting from the sale. So that will be 100 minus 5, and that will be 95. So the actual gain is calculated as the cost minus, as a cost. It's the net present value is calculated as the gain minus the cost. You have to take note of that. Okay, let's come to the C. The D rather. The gain to who? They are saying gain to who? Gain to the shareholders of what? The seller, isn't it?
Yes.
What will be the gain to them? What will be the gain to the company that they are buying?
The 5 million.
Okay, that will be 5 million. So you see that they are selling.
The cost to the buyer is the gain to the seller.
Exactly. So they are selling 100 million for 1 and 5 million. So they are making a gain of what? 5 million. So the gain that they are receiving of 100, 5 million of it is for the seller and 95 is for what? Is for the buyer. That's how we share the gain. Okay, let's look at the E, then we go and come. Okay. So supposing X buys Y by issuing 100,000 of its own shares to the shareholders of YY instead. If X had 20,000 shares issued prior to this transaction, compute the cost of this transaction if the post-announcement share price of XX rises from what? 10,000 to 108. So how many shares are they giving? How many shares are they giving for the acquisition?
10,000.
Okay, at what price? At what price? What is the post-announcement price?
So for me, 1 cedi.
Are you sure? It was first 10,000. They say the
10,000
post-announcement
shares.
share price rises from what? 10,000 to 10,800.
Okay, I was calculating like 1 for 1.
Okay, so the first one is, no, they are giving you all the 10,000 shares. They are giving you all the 10,000 shares at the current price. So first, before the share issue, it was 10,000, but it has now rise to what? 10,800. So it means that we'll be giving the 10,000 to them. So we look at the equity value. So the value of the equity that they are given. So they will be issuing 10,000 shares at 10,800, which is the price now. The price has moved from 10,000 to 10,800. So the new price of the company now is 10,800. Okay. What are we having?
$108,000.
108 million.
Okay. So 108 million. Okay. What will be the cost? What will be the cost now? You see that it will be 108 minus 100. We are giving 108 for what? For 100 million shares. So the cost of this particular transaction will be 8 million. But what will be the net present value under the share issue, the equity issue? What will be the net present value? The net present value will be the gain, which is 100 minus the cost. That will give you 92. All right, so let's go and come back at 9:20 so that we continue with the time value of money.
Time value. Time value of money. Question 1. Buhari Limited intends to purchase new machine costing 303,000 Ghana cedis. The funds to buy the assets are being provided as a loan by the CEO of the company at an agreed rate of interest of 12% per annum. The loan and the interest will be repayable in full at the end of the 4th year. To provide for the eventual repayment. The board of directors has decided to put an equal annual amount at the end of each year into a sinking fund account to earn 14% per annum. Required. A. What must be the annual payment into the sinking fund so that the loan will be repaid after 4 years? B. Draw up the sinking fund schedule for the first 2 years.
All right. So you can see that this question is having a compound interest together with what? The sinking fund. Can you notice that? Or you can see? Okay.
Yes, please.
Okay. Sinking fund, you have to know that if they say sinking fund, it's just like we are going to be setting, or we are going to be making a provision for a future commitment. Okay, the first of all, you have to know your future value. How much are you going to be paying in the future, and how much should you be contributing every year or every month towards that particular commitment? Okay, so you can see that the company intends to purchase what? A new machine costing 303,000. The funds to buy the assets are being provided as a loan by the CEO of the company at an agreed rate of interest of 12% per annum. The loan and interest will be repayable in full at the end of the 4th year. The loan and the interest will be repayable in full at the end of the 4th year is a statement to tell you that this is a compound interest. Because at the end of every year, the interest will not be paid and the principal will be left. No. The interest and the principal will be rolled over at the end of every year. This is a compound interest. The interest will be attracting interest and the principal will also be attracting what? Interest. But if they say it's only the principal that will be paid at the end of the 4th year, it means that at the end of every year, the interest will be paid. So the interest will be charged on only the principal, and that will be a simple interest. But this one, the interest and the principal will be paid in full at the end of the 4th year. It means that the interest and the principal at the end of every year will be rolling over or will be rolled over. That is a compound interest. Okay. The question now is, how much are we going to be paying to the CEO at the end of the 4th year? How much are you going to be paying to the CEO at the end of the 4th year? It is that particular amount that will be making the provision towards it. It is that amount of money that we have to be making the provision towards. So first of all, you have to know the amount that you'll be paying to, or the amount that you'll be paying to the CEO at the end of the 4th year. How do we do that? We take the amount that we have taken from them currently. We try to charge the interest on it every year by a means of compound interest. So what we do is we first of all have to find the amount that we'll be paying in the 4th or in 4 years' time. Okay, so we have the one, you now find the future value of the amount that you'll be paying. So that will be present value into bracket 1 plus R exponent n. So how much will you be paying in the 4th year, or at the end of the 4 years, how much are you paying to the CEO? Okay, so we now look at our future value multiplied by, currently we are taking 303,000 from them at an interest rate of 0.12. Okay, this is the compound is going to be done at the end of every year. So we do exponent 4. How much are we getting? How much are we getting?
We are getting 476.
Okay.
The future value 476,776.37.
Okay. 776. Okay.
Yes.
So you
0.37.
You can just leave it to the. You can just leave
Whole
it.
number.
Okay. All right. So it is
Then
this
the whole
amount.
number.
It is this amount that you are going to be paying at the end of the 4 years, isn't it?
Yes,
Okay.
please.
So you want to be putting an amount somewhere every year so that at the end of the 4 years, you'll be able to get this amount and pay. So this is now the future value, and this is the amount that you'll be contributing towards every year. So they are asking you that the question they're asking you now, what must be the, okay, to provide for the eventual repayment. The eventual repayment is the amount that you'll be paying at the end of the 4 years. Okay, the board of directors has decided to put an equal amount at the end of each year into the sinking fund account to earn 14% interest per annum. So the question is, how much every year, how much should we be putting into the sinking fund at a rate of 14%, so that at the end of the 4 years, it will give you the 47 something, the amount that is supposed to pay. So this is a future value of an annuity. What must be the annual payment into the sinking fund so that the loan will be repaid after 4 years? So we are looking for annuity. They say equal amount. Since they say the equal amount, it will be annuity. And this will be done at the end of every year. That makes it to be ordinary annuity. So this is an ordinary annuity, and this is a future value of ordinary annuity, because we are going to be paying the 476,776 in 4 years' time. So how much should we be putting into the account at the end of every year to be able to accumulate this particular amount at the end of the 4 years? So we use ordinary annuity, the future value of ordinary annuity, which is equal to 1 plus r exponent n minus 1, all divided by r, times the amount. Okay, but now we don't know the amount. We are looking for the A, which is the amount, but we know that the future value is 47776. Okay, is equal to 1 plus 0.14. That is the interest that the sinking fund will be bringing, all divided by 0.14 minus 1. Okay, then you multiply the answer by the A, which is the amount. What are we getting?
Okay. Do you want the final value or the breakdown?
Yeah, give me the breakdown for.
Okay, so the breakdown for the for the 1 plus 0.14 exponent 4 divided by this minus the 1 is this is what I'm coming.
Okay.
It's 11.06.
Okay. Okay, that will give you 11 point what?
11.06.
Okay. Multiply by A, isn't it?
Yeah.
Okay, now we are looking for A. What do we do?
Divide through by the 11.06.
Okay, 11.06. 11.06. So we have the A to give us.
So give us 43108.14.
43108.14. Okay, so that is the amount that the company. Yes, please.
Hey, I'm getting 4.921144.
Okay, this is supposed to be 1 plus 0.14 exponent minus 1.
Yes, divided by.
Okay. So you do this first, subtract 1 from it before you divide the answer.
Yeah. I'm getting 4.921144.
Okay. Okay. So 4.11. Okay, 4.92.
114.
Okay. It should be
1 1. Okay.
It should be to 3 decimal places.
All right, sure.
Ren.
Yes, please.
You mean the minus 1 is part of the
The top.
numerator.
Yeah, they are all part of the top.
Okay, sorry.
If that one, they will give you this one. You can just use it to find. They will give you let me check over here. They will give you future value of annuity. Okay. I have the formula sheet here.
Okay, then change the final answer, the amount.
Okay.
So that will give us 96,886.
Okay. I want to confirm. Okay, it's 4.921, isn't it?
Yes.
Okay, they will give you the formula sheet in the exam, so I have it over here. So that will give you
96,886.
Okay, 886. All right. So that is the amount that the company will be putting there every year. Okay. So they are asking us to draw the sinking fund schedule. So the sinking fund schedule is just you showing the growth of the fund. Okay, we do it in years. So you have the years here, you have the amounts, you have the interest, you have the deposit, then you have the total or the closing balance. Okay. So year one, would there be any amounts in the account at the beginning of the year? Are we going to put any amount into the account at the beginning of the year? Would there be any deposit into the accounts? No. So that will be dash. Would there be any interest for the year? Would there be any interest on the?
No, please.
Okay. But at the end of the year, what are we doing? We are going to be doing a deposit of 9688 what?
6.
Yes. And that will still be the closing balance for us at the end of this year. So 96886. Year two, what will be the balance in the account? Would there be a balance at the beginning of the year?
Yes.
Okay, that will be 96886.
96886.
Okay, what will be the interest for the year? The interest will always be charged on the balance from the beginning to the end. So the interest is always end on the amount that you have from the beginning to the end. Okay, so what will be the interest on this particular amount?
13,564.
Okay, 13,564. Would there be any deposit at the end of the year? There will be a deposit of
We are depositing the 96886.
Okay. So for the deposit, it will still be the same amount for the 4 years. What will be the total amount in the account now?
207,336.
207,336. Okay. So they say we should do it for only 2 years. If you like, you can add a 320. That will be the opening balance 336, and that will now attract interest. Then you do deposit of 886. Then the closing balance will come. The 4 will come, and you do it like that. That's how we do the sinking fund. It's different from low amortization. The sinking fund, the amount will be increasing, but for the loan amortization, you are paying. Sinking fund, you are depositing. Loan amortization, you are paying. So your money will be reducing. The sinking fund, it will be increasing because you are depositing. Okay. So what you have to know is that the sinking fund, you are making an equal amount into the fund towards the payment that you are going to be making in the future. So you first of all have to know the amount that you will be paying in the future, so that you can start making provision for it. So the sinking fund, you always have to calculate the future value. How much am I paying in the future? Then you use that particular amount to find the equal amount that you'll be putting there using maybe the future value of annuity due or future value of ordinary annuity, depending on how the deposit will be done. If it is done at the beginning of the year, that is annuity due. So this particular formula, you will modify it by adding 1 plus R to this particular one. That is annuity due. But if it is ordinary annuity, the deposit is done at the end of the year, then you have to just use the first one that we have used. So first of all, know the amount that you are paying at the end of the period, and now use that particular amount to find the equal amount. So the sinking fund, you are going to pay a future amount and you want to start saving towards that particular amount. All right. Let's look at the other one, which is very simple, but also somehow technical. Okay. Adam, can you take that one for us? Okay, these questions, they are not even plenty, so we can.
Okay, question 2. Your father is planning for your younger sister's university education to begin 10 years from now. He estimates the yearly tuition, textbooks, and living allowances to be approximately 20,000 per year for a 4-year degree. Required A. How much would he have to deposit today at an interest rate of 8% for your sister to be able to withdraw 20,000 Ghana cedis at the end of every year for 4 years? B. If your father decides to put an equal amount in a fixed deposit account at the end of every year, how much would he deposit every year at the same interest rate?
Okay. What are they saying? All right, how do we go about this question? Okay, you see that in all, the period for the investment will be what? In all, what will be the total period?
14 years.
14 years. So if you're able to understand that this will be for 14 years, then that is the first step to solve this question. Okay, they're saying that your father want to start what? Saving now. Okay. So now your sister will start schooling 10 years from now. And your sister is going to be spending 4 years in the university. So in all, it will be 14 years. Okay. What you have to do is that you know that from the 11th year, your sister will be withdrawing what? 20,000 every year, isn't it? Okay.
Yeah.
First thing that you have to do is that if your sister is withdrawing 20,000 every year, what should be the present value at the time that your sister should start schooling? That is the first step of you. So you assume that your father is going to be putting the money into the account so that at the end of every year, your sister will be taking what? 20,000. If you are making a withdrawals, it is seen as a loan because the loan will be paying equal amounts. So we always use the present value for the withdrawals. So what amount should we put in the bank today so that at the end of every year, you'll be taking what? 20,000. So what we do is that we assume that today is the first day that your sister is going to start schooling. So your father wants to deposit the money today so that at the end of every year, your sister will be taking 20,000. So how do? We find the present value of ordinary annuity using, so we find the present value of ordinary annuity. That will be question 2. So we first assume that today is the time that your sister, from now to the 4th year, your sister will be paying the money and your sister will be taking 20,000 every year. So it's starting from today. You first assume that it is starting from today. Then you calculate the present value. Okay, so let's come here. So we have the present value to be just like the normal annuity that you do. So this will be multiplied by the amount into bracket 1 minus into bracket 1 plus r exponent negative n all divided by r. Okay, and the present value, the amount that we'll be having is, we want to know the amount that we are putting in the bank today so that at the end of every year, sister will be taking 20,000. So we have 20,000 multiplied by 1 minus 1 plus what? 0.08. Am I correct? Okay, exponent negative 4 all divided by 0.08. Is the interest rate 8%? Okay. Okay. How much are you receiving? How much are you getting? How much is your father depositing now? How much is he depositing? What is the annuity factor? I have the table here. Annuity factor for I'm having 3.312. Can someone confirm that?
Yes, please.
Are you using 14 or 4?
It's 4. The person will not be withdrawing the money every year, 20,000 for 14 years. This will be done for only 4 years. So you do the calculation from the 11th year. You assume that the thing is now starting from, your sister will start schooling from now. So you do for only 4 years because they will be withdrawing this amount for 4 years. So you do the calculation as if you are in the 11th year. Then the amount that you are getting, that amount is at the end of the 10th year. Then you now present value that particular amount to today's 10. So we are doing this calculation after 10 years. This calculation is done after 10 years because it will be after 10 years before your sister will be withdrawing the money. So you do the calculation as if the 10 years is now over and your sister will start withdrawing the money. The answer that you get, then you now present value to it. Yeah.
It's 66,240.
Okay. It's 66,000.
240.
Okay. 66,240. Okay. This amount, we are doing this in the 11th year or at the beginning of the 11th year or at the end of the 10th year. This is the calculation. Okay, because the education will start 10 years from now. So we are doing this in the what? The time that your sister will start withdrawing the money, which is the 10th year. So this amount will be there in the 10th year, but we want the money to be here today, which is 10 years from now. So you now take this particular amount as a future value from today, then you now find the present value of this one using compound interest. So you now find the present value of this amount using compound interest. So present value is equal to future value divided by 1 plus r exponent n. So we have the present value, which is the today's one, is equal to 66,240 divided by 1 plus r 0.08 exponent 10. These amounts have to be in the accounts from the 10th year so that your sister will be taking okay, your sister will be taking 20,000 every year. Your sister will be taking the 20,000 and that 20,000, the remaining amount will still be any interest. Your sister will not take all the amounts. They'll be taking 20,000. It means that the remaining one will still be any interest. What are we having? The present value is equal to 66,240 divided by 1.08 exponent 10. So there's some people, they had an idea about it, but they were able to get only the 6424. You are calculating the 6424 from 10 years now, not the today's value. So after getting this value, then you now present value it because we have calculated this as if your sister started withdrawing the money already. So this is after 10 years time. They are talking about today. So you present value this amount again. What are we getting?
Got 3683.
3683. Okay. So that is the amount that your father has to put there. Okay, your father will put this money over there. So that at the end of the 10th year, it will be 66240. Then your sister will start withdrawing 20,000. And that will still. All right. So the B part is saying what?
Sir,
Yes, please.
sir. And please 20,000 times 313 and 3.312 to be 66242.54. It wouldn't be that.
It wouldn't be what?
The amount the amount we should be 66242.54. The one that is circled.
It will be 42.
It's because of the approximation, so it's
Okay.
No.
3.312 times 20,000.
It's less
I'm
than
getting
5.
66240.
It's supposed to be 82.
Don't go and be multiplying by, you approximate the annuity factor to 3 decimal places before you multiply. You are using the whole figure. That is why maybe you are getting the 42. We are using
yeah.
2 decimal
I got
places.
the same thing. That's why I'm telling her that's the approximation.
So you always approximate the annuity factor or the discount factor to.
Hello.
Yes, please.
Hello, sir. Sir,
Yes, please.
yes. The last one, the PV,
Yes,
is
please.
supposed to be 82, not 83.
The approximation is what?
It's supposed to be 82, but you make it 83.
What is the 82 points? Mention the figure that you have gotten.
It's 82.29191.
Okay. So it's supposed to be 82. Okay.
Yes, please.
All right. Yeah, the person saying the 42, don't use the full value. Use 3 decimal places. But if you are using the full value, you can still write your full value there. But we prefer the 3 decimal place of the discount factor and also the annuity. Let's talk about the B. Let's talk about a B. Okay, if your father decides to put an equal amount in a fixed deposit account at the end of every year, how much would he deposit every year at the same interest rate? Okay, this is also very simple. If you get the first one, then you don't have to worry again. Okay, your father will start what? You have to know the deposit period will end as soon as your sister started taking the money from the account. Are you okay? The deposit will end as soon as your sister started taking the money from the account. That your father will not put any money in the account again. As soon as your sister starts taking money from the accounts, no deposit will go there again. So your father is just saying that, okay, I want to put a certain amount of money into the bank so that as soon as your sister starts schooling, she can be able to use the amount that I've been able to accumulate at the time that she starts schooling. So that she'll be taking 20,000 and the remaining one will be any interest of 8% so that she can be able to manage for the 4 years. Okay, so you ask yourself, when would the deposit stop so that your sister will start taking the money? It will start from the deposit will stop at the end of the 10th year. And that amount that should be in the account at the end of the 10th year is 66240. So this is now a future value. And your father wants to operate what we call a sinking fund. You want to be putting an amount of money there. And your father supposed to be able to get 66240 at the end of the 10th year. So this is a future value, which is future value is equal to 1 plus r exponent n minus 1 all divided by r multiplied by the amount. So the future value is 66240 is equal to 1 plus 0.08 exponent 10 divided by 0.08 multiplied by the A. We don't know the A. So we do the same thing like the one we do. Okay, so this will be minus 1. So you do everything, then you make your A the subject. That is all about it. Okay, I saw someone saying I should explain the question again. Okay. They say your father is planning for your younger sister's university education to begin 10 years from now. He estimates the yearly tuition, textbooks, and living allowances to be approximately 20,000 per year for a 4-year degree. So your sister's education will start 10 years from now. Okay, as soon as your sister starts the schooling, your father will not put any amount in the account again. Okay, so what you are saying is that, okay, I'll be building a house. I'll be building a house at the starting from the 11th year, but I want to start putting an amount of money into the account so that the time that I started the project, I will go to the bank and be taking some amount of money from the bank. So if you are taking the money from the bank, it means that the remaining money that you will be taking some amount of money, the remaining will be there. The remaining will also be any interest. So you want to now get a certain amount of money for the project. So you want to start saving now. So you are saying that, okay, you want to start saving now so that at the end of the 10th year or from the 11th year, I'll be able to be going to the bank and be taking 200,000 every year or 20,000 every year. Then you now ask yourself, at the end of the 10th year, how much you have in the account so that you can go to the bank and be taking the 20,000 every year. You use that to find the present value of the amount starting from the 11th year. Assuming the money is now in the bank, how much should you have in the bank so that you can be taking 20,000 every year? The 20,000 that you'll be withdrawing will start from the 11th year. So you ask yourself, how much should I have in the account so that I'll be withdrawing 20,000 every year? You find that particular amount, and that is the 66240. That 66240 is not today. No, because you will not start withdrawing today. You start withdrawing from the 11th year. So that particular amount over there is at the beginning of the 11th year. It's at the beginning of the 11th year. So how much should you put in the account today so that at the end of the 11th year, you'll be having the 66240? You will now present value that one using the 8%. Okay, that's how you go about it. It's very simple, but it's a bit complicated that for the time value of money question, that if you don't know, you don't know. It is very simple. You don't have to stress yourself. If you don't know, you don't know, because it's very technical. All right. We don't have to waste time on that. It's very simple. You can say the question is not even complicated. It's very simple. It's very, very simple, but Charlie, it's not easy. So you really have to be on top of issues for the time value of money. You really have to be on top of issues. Yes, you have to be very critical in analyzing issues. Okay. The 3-2 is a very simple one, but somehow complicated. Adam, take the 3 for us. And then the last one. Okay, I will send you some question on loan amortization so that you can try that one yourself. All right.
Okay, question 3. The total initial cost of a Daewoo Matiz taxi cab is 10,000 Ghana cedis. The expected rate of return for such investment is 12% per annum. An investor is planning to invest 50% of the annual cash returns from the taxi into an account which pays 10% interest compounded annually in order to replace the vehicle at the end of its economic life. Required: A. Estimate the annual cash returns, that's the annuities, to the investor if the economic life of the cab is 5 years. B. Estimate how much would be available for replacing the vehicle at the end of the 5th year. C. Evaluate the feasibility of the financial plan if the price of the cap increases at a rate of inflation projected at 5% per annum over the 5-year period. Yeah.
Adam,
Yeah.
what is the question? Break it down for us. Can you see what the question is saying for us? Can you be able to uh can you break the question down for us? What are they saying there?
Okay, I can see you reinvest. It's just reinvest. The cap's life is 5 years, so you have to invest in the next 5 years to match the cost of the car.
Okay,
That is what I see.
what do you have
The
to
first
know?
one.
What you have to know is that the cap, the amount that you are investing in the cap is not an amount that you'll be saying that at the end of the cap period you'll be receiving the principal together with the return. No, this is a capital investment. So at the end of the period, the assets will just be what? Will just be scrapped. So the cost will only be recouped through the return. It's not like shares that you are buying. You see, if you are buying shares, you see that at the end of the year, they will pay the principal together with what? The interest, because you are going to, the company will pay you back the share value plus the interest that they are paying, or if it is treasury bill that you are buying, okay, the government will pay you your principal plus the interest. But this particular one is a cap. It's an asset that you are buying. It's a capital asset that you are buying. Nobody is going to pay you the cost. No, you can only get a cost from the return that you are getting. So don't say that you are going to be compounding the principal. This is not principal. This is not principal. This is not shares that you are buying. This is no instrument, a security that you are buying that at the end of every year, they will pay you the initial amount plus the interest. No. So the only amount or the only return that you'll be getting on this cap is the 12%. So let's find the 12% on the cost. So if you buy the cap, the return that you'll be getting is 12%. What is the 12% on the 10,000?
1,200.
Okay. So how much will you be getting at the end of every year? How much is the return? 1,200. And this is the amount that you'll be receiving every year, isn't it?
Yes.
So that particular receiving it every year qualify it to be called annuities. So the first question, they are just asking you for the return, 0.12 multiplied by 1,000. That is 1,200. That is the amount that you'll be receiving every year. It's every year, so it can be called annuity. It can be called annuity. It's not that you have to do any calculation. No. It's every year, so it can be called annuity. That's all. Okay. So it's very simple, like ABCD. So
Is it the A we are doing or
is the
the
A?
first line of the sentence?
We are doing the A. That is the A. Estimate the annual cash returns to the investor if the economic life of the cap is what, 5 years. So the annual cash return is what? It's just 12% on the 10,000. That is the annual cash that you're receiving.
Okay, so there's no multiplication of 5 here.
No,
Okay.
if you are multiplying by 5, that is the total amount. Annuity means equal amount. That's all.
Okay.
Okay. So we have the annual cash returns. Annual cash will be 0.12 multiplied by 10,000. And that will give us 1,200. Okay. Let's now come to the 2. What are they saying?
So estimate how much would be available for replacing the vehicle at the end of the 5th year.
Okay. So how much are we investing? You see that
So
we are receiving
50%.
1,200. So we are investing how much?
50%.
Okay, the 50% will give us how much?
$600.
Give us 600.
Okay. And this 600 will be invested for 5 years, isn't it?
Yeah.
Yes.
So we do the future value is equal to present value. So this will be compounding. So future value is equal to present value 1 plus R exponent n. So our future value will give us 600 into bracket. What is the rate? If they invest it, it is what? Into an account which pays what?
10%.
10% interest what? Every year. Okay. Okay. This will be annuity. So an investor is planning to reinvest 50% of the annual cash flows from a taxi. So it means that every year they will be what? Reinvesting 600. So this will be annuity. Are you okay? Okay. Okay. So 60% of it will be every year, any amount that we receive, we will be investing 60% of it. So this will be annuity, 600 every year. Okay, so let me take this one off. This will not be present value. Okay. But this will be at the end of every year. So this will be ordinary what? Annuity, future value of ordinary annuity. So we have the amount multiplied by 1 plus R exponent n minus 1 all divided by R. So future value is equal to. Please, I hope we understand why we are using annuity. I hope we understand why we are using annuity.
Yeah.
Okay. So how much are we investing every year? You'll be receiving 1,200 every year, and you'll be reinvesting what? 50% of it. So every amount that you receive every year, 50% of it will be reinvested. So we multiply by 10, multiply by 1 plus 0.1 exponent 5 minus 1, all divided by 0.1. Okay, future value is equal to 600 multiplied by. So let me now look for.
6.105.
Okay. 6.105.
3663.
Okay. So 600 times 6.105. So we're having 36663.
Amina.
Okay.
Amina, come.
What are they? So that is the amount that you'll be having. Okay. Let's now come. C. Evaluate the feasibility of this financial plan if the price of the car increases at the rate of inflation, projected at 5% per annum over the 5-year period. For this particular the plan, is it going to be feasible? You can see the return that you are getting is even lower than what?
So I wanted to ask if the figure is actually correct because it's lower than the cost.
Yeah, they're just asking you a question. So if it is not feasible, then you just say it's not feasible.
Oh, okay.
Okay. So you can see that the replacement value at the end of the 5 years will be like this. Okay. The replacement value. So let's come to the C. Okay. The replacement value will calculate it based on future value. So it means that you can see that it is just one amount that will be increasing at the end of every year. So we use the compounding if it's just a single amount, a lump sum. Some people call it a lump sum. If you're just putting a single amount over there and you will not do anything again, then that is what we call we use the compounding for it. But if you are going to be putting an equal amount, you'll be putting an equal amount there at the end of every year, then that is what we call the annuity. So we have the future value is equal to the 10,000 into bracket 1 plus 0.05 exponent 5. So we have the future value is equal to we'll be having 10,000, 1.05 exponent 5. So what are we getting at the future value?
Getting 12,762.82.
You can see that the investment itself in the first place is not feasible. You'll be getting 1,200 every year for 5 years. That will give you 6,000. So you can see that the investment itself is not, so the plan is not what? It's not feasible. It is not possible that you can be able to replace this particular car with this particular current investment plan. Okay. Let's go to the last one. Let's go to the last one. And then take the last one for us so that we know this.
Okay, question 4. A company has a cash inflow streams from year 1 to 3, totaling 30,000 Ghana cedis. Management of the company has provided you with the below information to assist them in choosing the best cash flow streams. Streams A, B, C, D, and then years 1, 2, 3 with the total. So required, assuming the interest rate is greater than 0, which of the following cash flow streams would you recommend for the company and why?
Okay. Do you have any idea about how that particular question should be tackled? Adam, do you have any idea about how this particular question should be tackled?
Not really.
The questions are not difficult. These questions that I'm giving to you, how can someone give you this question in the mock? Or it's just that technicality is too much? Okay. So sometimes you should not judge people by looking at them. Okay. So this thing is not anything. The question 4 is not anything. But you just need a key. Yes, you just need a key. If you have the key, that particular key, then you are good to go. Okay. The question says that assume that the interest rate is what? Greater than what? 0. Okay.
0.
A company has a cash flow streams from year 1 to year 3, totaling what? 30,000. Management of the company has provided you with the below information to assist them in choosing the best cash inflow what? Streams. So when are you going to when are you going to tell them that they should do this, they should do this? It is now, isn't it?
Yeah.
You'll be advising them now. So the first thing is that you need to find a present value for each of the stream. But what are you going to be using? You can assume any discount factor because they say that you should assume that the interest rate is greater than 0. So you can use any interest rate of your choice to present value these cash flows because year one, this cash flow will arise at the end of the first year. So we want to advise them to make the decision today. We can only advise them by knowing the present value of each of the cash streams. So you can assume that the interest rate is what? 10%. It means that if you invest an amount for a year, it will attract interest of 10%. So you can assume interest rate of 10% and use the cash flows one by one. So let's assume that the interest rate is 10%. So the 4. Assume that the interest rate is 10%. You can also pick, anybody can pick any interest rate. They say you should assume that it's greater than 0. So you can pick 20, you can pick 15. Someone can pick 5. So let's look at the first one, the first stream. Okay. So can we do A? Okay, let's do stream A. Okay. We can do this one straightforward, but for the purpose of, because we are learning, I'll do it one by one. So look at the stream, then we have the A. Okay, someone can do years, someone can do years, someone can do the cash flow, someone can do discount factor, so someone can do present value. Okay, you can also do it like that one. Then you do the year 1, 2, 3. Then you put the cash flow and the discount factor over there. We have another way of doing that. Someone can also calculate the total present value like this. The net present value will be calculated as the future value 1 over 1 plus r exponent n plus future value 2, 1 plus r exponent. Okay, so this will also be, so let's say this is, someone can say if this is 1, then this will be n plus 1, anyhow you want to do it. So we can just name it straightforward like this as 1, 2, then we have future value 3 divided by 1 plus r exponent 3. So let's just use any of them that you use, you'll be getting approximately the same answer, and your decision will always be the same. Okay, so the cash flow for the first, the stream A, what is the cash flow? It's 2,500, 7,500, and 20,000. So we have 2,500 divided by 1.1 plus 7,500 divided by 1.1 exponent 2 plus 20,000 divided by 1.1 exponent 3. So you get a total present value and put it there. Then you come to stream B. The B, use the same approach for it. NPV is equal to, so let's take the cash flows one by one. Okay, I'm saying that someone can do the year 1, year 2. Me, I'm using time. I'm very, like, for the time there, I care about time. So I can't be doing maybe some 4 marks or 5 marks, and I'll be putting a table. No. I just do the simple one and move on. Okay, so I'm having 10,000, 10,000. So 10,000, 10,000, 1.1 plus 10,000, 10,000, 1.1 exponent 2 plus 10,000, 1.1 exponent 3. So you also find your present value and put it there. Then you come to the C. The C, you also find the present value of, what is the first cash flow? Year 1. Okay, 20,000 divided by 1.1 plus 7,500 divided by 1.1 exponent 2 plus 2,500, 1.1 exponent 3. So let's count to the D. The net present value is equal to, what are we having? What is the cash flow for each of them? 2,500, 20,000. So 2,500 divided by 1.1 plus 20,000, 1.1 exponent 2 plus 7,500, 1.1 exponent 3. So can someone give us the cash flow for each of them? Year 1 is what? The stream A is what? The net present value for the stream A.
Okay. Stream A is 23497.37.
So 23497.
0.37.
Okay. So 23497.37. Okay, let's come to the B. What are we having for the B? The stream B, what are we having?
Stream B, 24868.52.
868.52. Okay.
52. Stream C,
Okay.
26258.45.
Okay. 26258.
258.45.
Okay.
D 24436.51.
24.
436.51.
Okay. So based on this one, which of the stream that they should choose?
C.
They choose which one? They should choose the C.
C.
Okay.
C has a higher MP.
Okay, that is it. That's all. It's very simple. The time value of money question there. That one, if you don't know, there's nothing that you can do about it. It's very technical, and they have even removed it from the new syllabus, but it is now under investment appraisal. But we don't know how they are going to examine it. But for now, there it's 10 marks, and you can't go to the exam without saying it. Question 3A, 10 marks. So you really have to solve more questions on the time value of money, and understand it also as well, because it's very technical. It's very technical. Okay. So seniors, if we don't have any question, then that is that for today. We have done business valuation. You can try the other question, the question 3, and the business valuation on your own. I will send you some questions on time value of money. And tomorrow we look at financial risk management, and we look at this one. We start with the investment appraisal. We start with some parts, so that Friday we complete it with the working capital management. Okay. So if we don't have any issue, Any
Yeah,
question?
Linus.
Yes, please.
So yesterday I was asking about when we get the business valuation with the growth. I think that was the first time they examined it last night.
Okay.
So if we see something like that again, do we calculate it using this kind of formula, like the way we've done the NPV here?
The growth, what you do is that you see sometimes they will say they will give you a different rate for the dividend, isn't it?
Yeah.
Okay. And they will say that up to this time it will now be up to perpetuity. Okay. So what you do is that one thing that you have to know is that the present value of all cash flows that you'll be receiving under the stream should give you the value of the stream as at that date. So what you do is we can also find the market value of a share using the dividends. What we do is that if you are giving me 20,000, that I should start business with 20,000, any amount that I'm going to be paying to you will be because of the 20,000 that you have given to me, isn't it?
Yeah.
Okay. Because the money will be with me for some time, you are factor in time value of money. That is why the dividend is 20,000 or 20,000 every year because of time value of money. So you have now factor in the time value of money into the dividends. So the question is, if I should pay you those dividends today, the dividend I'm paying to you in the future, the today's value of the dividend should be equal to the amount that you are giving to me. But because of time value of money, that is why the dividend payment or the amount that I'll be giving to you at the end of the time that the money will be with me is different from the amount that you are giving to me because of time value of money. So what we do is that if I should give you the dividend today, it should be equal to the today's value of all the dividends should be equal to the amount that you are giving to me. So you find the present value of all the dividends. So they can say that the current dividends is 60 Ghana cedis. Okay, they will say that these dividends will grow at 2% for the next 2 years. Okay, present value, the discounting starts a year from now. So that today's dividends will not be part. We don't add the today's value because the current value of the dividend is still the 60. So we do it from the next year. We find the present value. So cash flow should be arising at the end of every year. So we start the discounting for the next year's dividend from today. So if the dividend is increasing by 2% every year, the next year will be what? For 2 years. Next year dividend will be what? Okay. So next year will be, so let me see, next year will be 1.02 times 60. Is that correct? Okay. So N2 will be 1.02 times 1.02 times 60 because the first year's own or the next year's own will grow by the 2% again for the subsequent year. So what is the dividend that you're getting for the first year? I'm getting 61 points.
61.2.
Okay. Then you now increase it by 2 again. I'm getting 62.24, isn't it? Okay. The question will say that then it will now grow by 5% from year 3 to year 4. Then after that one, it will now grow at a rate of 3% into perpetuity. So you have to know year 4 too. So this will be 0.05 times what? 62.24. It will be the second year's own. This one will now be growing by 5%. So what are we getting for this? Okay. So let's multiply the. I'm getting 65.54. Okay. So this will now, this will also now grow by the 5% for the next year. So 65.
I got 65.35.
Hey, it's 5% though.
65.35 too.
Okay, I'm coming.
It's 65.5452. So maybe 65.55.
Okay. I'm coming. I mean, I haven't done anything well. 62.24 times 1.05. Okay, 65.35.
Yeah.
Okay, 65.35. So this will also grow by this rate. And what are we getting?
It's 1.05.
68.62.
Okay.
And they say then from here, it will now grow by 3% into perpetuity. So these are the dividend for each year. So you now discount them, you find the present value for. So you do your years, you do your cash flow, you do your discount factor. The question will always give you the cost of capital of the company or a similar company that is in the industry. You just pick that one. Or if you have any information that can help you to calculate the cost of capital of the company, that is fine. But the question will give you. So you have year 1, year 2, year 3, year 4. So you have 61.2, which is dividend a year from now. This will be 62.24 2 years from now, 65.35 3 years from now, and 68.62 2 years from now. Then you count to the one with the what? The annuity. Okay, the one with the perpetuity. You see that the perpetuity, it is now a constant growth. So what we do is that we use the dividend, we use the cost of equity formula to find the market value as at that date. So we now have the PO plus G. So what do? Your PO will now be equal to DO 1 plus G over KE minus G. So the G that you use over here is this dividend. You are going to be estimating this at the end of the 4th year because we are doing it for next year, but this will be done at the end of the 4th year. So if you are calculating the cost of equity, it is next year calculation that is done in this year. That's why we do the growth. So you'll be doing this particular growth at the end of the 4th year. So you have the 68.262 that will grow at 1.03. Okay. Then if the cost of equity is 15%, you have 0.15 minus 0.03. So the value that you'll be getting is at the end of the 4th year. So you bring the total value over here. Then you also use the discount factor at the end of the 4th year to discount it because you are estimating this at the end of the 4th year. It is at the end of the 4th year that the dividend will now grow at a constant rate to perpetuity. So you find the value over here, and that will be seen as a value at the end of the 4th year. Then you now discount it, or you add it to this particular one, then you discount the two using the discount factor at the end of the 4th year. It's very simple. All right. So that is it. Okay.
I'm calculating it though.
Brain.
Yes, please.
Our value for the N2 is not correct though. Supposed to be 62.42.
That is how come.
And so that is where the problem was coming from.
And so the figure that I had for this one is correct, isn't it?
Yeah, it was correct.
Because I just multiplied the thing for me. So it's supposed to be 62.42. Okay.
Yeah.
So that this will be 54. Okay.
So or maybe 53.
Okay. Because okay, so let's make this one 54. Okay. So which means that this one also will be 0.
So N4 will be 68.82.
Okay.
82.
Okay. Okay. Please, the premium one that we have done, the market value and the floor value, you have to really take your time and go through it again because they haven't examined it before. Okay. They haven't examined it before. So anything is possible, but the time value of money and the business valuation question really have to be on top of issues because they are the troublesome questions now in the FM. Okay. So I really have to be on top of issues. So Okay. So what you do is you just find the discount factor for these ones, then you present value them. Then the total of it is the value of the company using the dividend valuation model. So sometimes you can use the dividend valuation model using the cost of equity formula straightforward. But sometimes they will give you the dividend growth separately. You have to go with this one, present value, then you move on. So the total present value will give you the value of the company.
So I'm getting some big figure for PO.
Okay. So the PO is what?
The PO is 590.66 or 67.
Okay. Let me confirm that. Okay, 590.71.
67.
Okay. I'm getting now it should be 68.82 because we have changed this figure to 82.
68.82.
Okay, and the down will be 12%.
Yes.
Okay.
0.82 times 1.03
Okay.
divided by 0.12. Okay, so 590.71.
Okay. Okay. So you now, or you can, if you like, you can add this one to this one. Okay, because they all be done at the end of the 4th year. Then you just discount it using the 4th year discount factor. So you put the discount factor over here, discount it, then you total the present value. The total present value is the value of the company. All right. Adam, I hope you're okay now.
But
So
I
the
was thinking
590.
maybe the 5th year, when they say perpetuity, you use maybe the N4 and then you divide by the rate so that you get a perpetuity before you come and do use it down for maybe the DO.
If you get a perpetuity, then you have to subtract the perpetuity that you are doing it as if it is now. So you have to subtract the discount factor from the remaining years before you find the perpetuity from that year.
Okay.
Okay, so if you are doing the 1 over R, you see the 1 over R that you are doing it as if it is now.
Yeah.
So you have already done 4 years already. So what you do is that you have to go and you have to add a discount factor one by one for the 4 years and go and take it from your what? No, you have to do the discount factor because this will be done at the end of the what? The
4th year.
The 4th year. So you have to do it 1, 2, 3 and take it from that figure. Then if you multiply, you'll be getting, I'm sure you'll be getting the same value. Okay. Because you have already done 3 years already. So you have to take 3 years from it. Then you start from the 4th year. Okay. All right.
All right.
So I hope we don't have any issue on the business valuation. I got to a point I was confusing you, but how you would learn. You have to take it like that. It is part of the process. Okay. So that is just by the way. And if you don't have any other issue, then we move on to tomorrow. Financial risk management and investment appraiser. And we try to finish it. We try to finish it on Friday. All right, seniors, if we don't have any other issue or concern, I'll leave you guys over here so that you can continue with your other activities. Okay. So that is that. I will see you guys tomorrow.
Thank you very much.
Okay.